Hey, what is up, everyone? I hope you were having a phenomenal weekend. I hope you're having a great Sunday. If you're watching this on the replay, I really appreciate you. In this stream, we're going to go over some stocks that I recommend to buy this week. Of course, none of this is financial advice, but I'm going to go over some stocks that I think are pretty good buys. And then we're going to deep dive into the stocks that you guys have in the chat for me to analyze. So if you like this kind of stuff, it would mean a lot if you'd leave a like. And let's just get straight into this. So here, I'll start with a portfolio update. Then I'll share with you a few stocks. I'll be quick with this update. Here is my Moomoo portfolio. In the top left, it is called my buy and never sell portfolio because once I buy a stock in here, I genuinely try to never sell it. I don't trim it. I don't even take profits. Like Powell Industries, we're up 10x on this stock, but we've never trimmed or sold a single share of this company. Same with Comfort Systems, we're up 17 grand on this stock. We only put 4 grand into it, and I have yet to trim even a single share. So I'm kind of just letting the rides gain in this portfolio. Some stocks that have been our most recent purchase in here is actually Moog. We bought this one about a month ago, and they hit an all-time high. It's an aerospace and defense company. It's one of my favorite ones with so many patents. The Voyager space aircraft that's still out there uses their patented valves and industrial military aircraft products. So yeah, anyway, Moog's a really cool company. So that's that portfolio. We also have a Webull account right here. And by the way, I made that portfolio because my biggest regrets in the market were selling stocks for a gain. Like specifically Palantir. I sold Palantir at $10 a share for a 30% gain. Now it's 120. I'd be up 1,200% if I didn't sell. I used to have 55 more shares of Robinhood. Look at this. There are my sell orders. I sold 55 or 58 shares at like $30 a share. Well, now it's $95 a share. I still kick myself in the nuts for selling and trimming this. So that's why I made that portfolio. I really believe the way to get ahead in the market is to not trim or sell your stocks even after they're up. Like I know AMD is super overvalued, but I'm not fully selling out of my position even though I'm up 300%. So here are my largest holdings in here by equity. AMD is our largest holding, then followed up by Moomoo, then Microsoft stock. Microsoft has been phenomenal. Has anyone seen the software sector rally? Here's a software name that has not done too well, UiPath. I'm down 45% on them. Dave, if anyone's heard of this company, it's like a consumer fintech finance loan company. They're pretty cool. They just hit an all-time high. Southern Company, regulated utility. AppLovin, one of my favorite. I've been shilling this software name like crazy, and I am so glad it has done so well because I know a lot of people got into AppLovin at a good price. Reddit as well. Out of all the software stocks we were buying on the dip, we also bought a share of Reddit down here as well. And that leads me into my next point of the stocks I recommend I think are going to be a good buy for this week. And watch out for that person in chat there. Hold up. Yeah, I sell nothing. I'm just trying to give my opinion. But yeah, we also have Robinhood stock. That's the one I regret the most selling out of. We got SoFi. We'll go by our biggest winners. So AMD is our biggest winner, followed by Dave, Clear Secure, Reddit. And then here's our biggest losers, UiPath. So if you're wondering what is my all-time performance, well, I'm fully transparent. Here's my lifetime gain. We're only up 28% all time. So that doesn't, beat the S&P 500, but it's still, I'm not going to complain about that. We're up 28% all time. So that's that portfolio. We also have a Robinhood account. This is another brokerage I have. We're up 16% the past year or year to date. Actually, that underperformed. See how we're up 16% the past year? From exactly 1 year ago, the S&P 500 is up 28%. So yeah, we did unfortunately underperform a little bit. But yeah, another one where I'm not going to complain about, still I'm not going to complain about a 16.5% gain. Here are all the stocks that we own in here. Most of these are S&P 500 names that you've heard of before. Google, McDonald's, Meta, Constellation Energy, the nuclear company that owns 30% of all the US's nuclear reactors. If you're looking for a nuclear play, I genuinely believe CEG is the best one. It is the best one. And finally, oh yeah, here's our total percent change on every stock in here. So yeah, we're up on every single stock except for McDonald's. McDonald's is our one that's kind of struggling right now. But yeah, Google's been phenomenal. We're up 130% on them. It's our only stock that's doubled in here. United Rentals has been a good one. Constructing data centers has been a very nice tailwind for their financials. And then here is our Roth IRA. It has not done too well in here. We started this basically exactly 1 year ago, and we are down 2.6%. As you'll notice, I kind of keep it simple. I don't really got any crypto or options. I mainly just buy and hold stocks in a few of them. Like in this portfolio, I have 4 stocks. InnoData has been our phenomenal software name, up 210%. But yeah, in this portfolio, we just got 6 stocks. In this portfolio, we just got 6 stocks. So I try and keep it simple. So yeah, now let me get to the list of stocks that I really think are a good buy this week. And some of these I do own, but this first stock is one that you've heard of before. And I think that this is going to be a very good, or they're going to be on their advertising growth expectations. So the stock I'm talking about is actually Netflix. You're probably a subscriber to them. They actually just rose prices. And I don't know about y'all, but we're not canceling our Netflix subscription, even though they rose it by a dollar, or was it $1.99 a month now? They have the pricing power, and I think their advertising business is going to exceed even YouTube's advertising growth. So you can pick up Netflix today at a 25 forward PE. What does that mean? That means they're only trading at 25 times next year's net income. And here's a cool metric. Netflix has 300 million premium subscribers, and they make an average monthly ARPU, or average revenue per user, $11.69 per month per paying membership, which is ridiculous. And here's their net income they're making. They had a slight one-time adjustment this quarter because from the Warner Bros. Acquisition, they received a $2 billion free termination fee, so it boosted their net income this quarter. But excluding that, they're always making $2.5 to $3 billion of after-tax net income every quarter. And same with FCF, which is free cash flow. So this is just a money printer. You can buy a great subscription model company. Especially if you pay for Netflix, why not own the stock as well? They're on a dip right now. I actually think they're undervalued at this 25 forward PE. So yeah, it's a cool advertising subscription model company. Analysts love subscription model companies. It's all reoccurring. It's predictable. So yeah, and some people forget about their Netflix subscription. Whether or not you're watching it, they keep that monthly fee. So that's Netflix stock is my first one. I think is a good one. Hey, what's up, Bogdan? Hope everyone's having a great Sunday today. Thanks for all the gifts and stuff. Draco, man, appreciate you, brother. So the next stock I got up, I really recommend is Uber. You can basically get in at the same cost basis at me, or I bought in at $69. It's $70 today. I really have a good pitch for Uber. They're really getting into autonomous vehicles. I really think it's the platform you go to book a robotaxi. That's where the money's to be made. They don't have to own any robotaxis. They can just collect a high margin fee every time someone books one. Uber proposes takeover of Delivery Hero, raises stake to 36%. Oh, that's cool. Uber exhausts full year AI budget in 4 months, questions ROI and R&D spend. Oh yeah, so they are spending a lot of money right now, but that's because they're just doing a bunch of acquisitions. They just bought Spot Hero, which is a parking app. But check this out, Uber, this is a cool metric. They have monthly active consumers, not just monthly active users, but monthly active consumers of 199 million this quarter. When the same time last year, it was 170 million. So they really are growing their monthly active consumers. They're in mobility, which is ride sharing. They do delivery. Look at the Uber Eats delivery, and it's not just Uber Eats, it's also B2B, business to business delivery growth. That's the highest growth rate on the entire screen, 35% at the top. I'm very impressed with this. This is why I don't think this one should be on such a massive decline right now. It's kind of just a lot of software name is, and they're not even so much a software company. Cool thing about Uber is they're the most profitable they've ever been. Remember back in 2021, who was buying this? They were losing 500 mil a quarter. Well, look at Uber today, and these are phenomenal year-over-year growth rates. They're making 1.5 to 2 billion of net income a quarter, and not just net income, but FCF, which is free cash flow. They're making well over 2 billion of free cash flow every quarter, and they have no net debt. So that's how they're able to do all these acquisitions. I had a list earlier. They own a huge stake in Joby Aviation, huge stake in Lucid, huge stake in WeRide, and Serve Robotics. They have a stake in. I think I said Joby already, but yeah, anyway, Uber is really cool and they have such good growth and they're not being priced in the valuation like a growth stock. They are literally trading at a 19 PE or a 19 times net income. For the growth that they have, I personally think that's undervalued. And for the acquisitions that they're doing, this is just one that I'm personally buying on the dip. Would you go all in at today's price? No, but you probably start the nibble. Like if you wanted Uber as 5% of your portfolio, don't make it 5% today, but maybe go ahead and make it 1%. So there's my position. I got 12 shares at $69 and it's, $70 today. So that's the other stock I had. What's up, Tom, Plasma, Demones? Hope everyone's having a good day. Thanks for everyone showing up on both streams here. So, hey, Plasma, dude, thanks for those gifts. And Bogdan said he's a 3-month fan. Dude, I appreciate you, brother. So next up, I wanted to go over Lowe's stock. This is the last one I have on the list. Then we're going to get into y'all stocks in the chat. I see like Keel Infrastructure, Baba, and Alibaba, Walmart. We'll check out all of these stocks. So here's Lowe's right here. This is an interest rate sensitive sector. As we know, people buy Lowe's and wood to renovate their homes and mulch and stuff like that. But as we know, interest rates have really killed real estate right now. Rates are high. No one's really buying a house with mortgages at 7%. So the renovating and upgrading your house's spend has really, declined as well. This is still a great dividend growth stock. If you buy Lowe's right now today, you get a 2.3% dividend. So you're still getting 2.3% of your money back no matter what, just in the form of a dividend every year. We also have a 17 forward PE, so they only trade at 17 times net income. And check out their net income. Actually, they had a slight one-time adjustment. They're literally making 1.5 to 3 or basically 1.5 to 2 billion of net income every single quarter. So that's cool. I mean, in our neighborhood, they force us to like update your mulch every year, and we in our whole neighborhood just go to the closest store, which is Lowe's, to get all our mulch and stuff. So they probably have a nice little reoccurring revenue stream. So yeah, they're still up from their 2019 price. It's a dividend growth stock. You should get a couple percent stock price appreciation on top of the 2.5% dividend you get every year that they raise. So that's the last stock I had. One reason real estate is beat up again is because of these Fed rate cut expectations. We can see for their June meeting, 99% chance of no rate cut. Their July 29th meeting, 95% chance of no rate cut. September meeting, 82% chance of no cut. And there's actually a 17% chance of 25 basis point hike. We have literally more chances this year of interest rate hikes than interest rates going down. So imagine if rates go up another percent. That obviously wouldn't be great for real estate. So what did you go over before Uber? Yeah, the stock I had before Uber, I have a watch list here. We actually went over Netflix. So these were the three stocks I really like. Uber, Lowe's, Netflix right now. So yeah, let's check out all of y'all stocks in the chat here. And dude, Plasma, that was so cool looking. I just saw that. It's like a hand heart. Man, thank you very much, Plasma. If you have a stock you want to look at, definitely let me know. I appreciate you. All right, so let's see. Walmart stock, yeah, they're cool. They're like a bit recession resilient. Even in a recession, people still got to get groceries and toilet paper and all this stuff. And what I really like about Walmart is their Sam's Club business. So, we just recently became a Sam's Club member. They had a lot of new signups because oil prices. Walmart expands 30-minute delivery service to 33 U.S. markets, covering 19,000 zip codes. So Walmart is spending all of their free cash flow trying to keep up with Amazon. And that's the tough part. So the reason they fell is because of a free cash flow problem. They actually lost, if we go to free cash flow, it was negative $2 billion. They spent a ridiculous amount of money investing in their fulfillment centers and robotics, trying to compete with Amazon because they're getting their lunch eaten by Amazon, because anything you can get at a Walmart store, you can order on Amazon. And Walmart's like, okay, shoot, let's also make our own online delivery service. And that's what they're doing. So they're investing heavily into robotics. So I'm actually a big fan of Symbiotic as well. SYM stock is money going from Walmart to them. Walmart's the biggest shareholder of that company. But check this out. Walmart still prints net income every quarter. I would not be worried about Walmart. They still make 5 to 7 billion of after-tax net income a quarter. The only thing that sucks about Walmart is it's even on this little dip, this like 7% dip, they're still expensive in my opinion at a 39 forward PE. So they trade at 39 times next year's net income. That's more than double that, it's double the S&P 500's multiple. So, but it's kind of the whole industry trades like that because it's so predictable. It's such a safe business model. Same with Costco, which is similar to Sam's Club. Another one that trades at a 44 times net income and is expensive, but they deserve to be. Next up is BR stock. What is BR? So I wonder if Broadridge Financial Solutions. Oh, hey, we'll look at SoFi after this. Is this Moomoo? Yeah, hey, or what's this platform? It's actually linked in my profile thing there. Yeah, my bio. If you'd like to get this app I'm on, it's actually a brokerage. So affiliate link too. So if you want to help me out, that'd help me out. Oh, we'll look at ALAB. Yes, sir. Plasma, look at Altera Labs after this. So here's BR stock. So I'm assuming this is like a information technology, investor communication. Okay, well, they traded an 18 forward PE, so they traded 18 times net income. Investor communication solutions. I don't know what that is, but it's up 9% year over year. Their global technology operations is up 5% year over year. So both of the businesses combined, revenue grew 7.8%. So it's kind of like mid-single digit growth. The revenue is not explosively growing. That's probably why they're at a 17 forward PE, because it's not insane revenue growth, but they still print net income every quarter. If we zoom out, that the profits are actually growing faster than the revenue. So that actually means margin expansion. Check out the past 4 quarters in a row. The net margin grew massively from the previous same time last year. So I'm actually really impressed. They're still making 200 plus mil in net income a quarter. They do have a bit of leverage, but you get a 2.5% dividend yield. I wonder if they're just being eaten up by AI. I don't know too much about them, but maybe whatever this company does, people can recreate it with Claude Code or Vibe Code it away. I just don't know that. So there's definitely some context I'm missing here. But also this brokerage, what is this right here telling me that there is a bullish continuation wedge. It looks like, according to this, the rise probability is a 95% chance. So, hey, maybe there's your technical analysis. I don't really do much technical analysis. I like looking at the fundamentals, but maybe all the worst news is already priced into the stock. Hey, how's it going, Jerry in New York? Said, do you still have InnoData? I do still have InnoData. They have been a phenomenal performer in my Roth IRA. So they're actually my best performance stock in here. We put $330 into them, and it's over $1,000 position now. We're up $715. That's what I recommend with some of these super small, tiny stocks. You don't put a meaningful amount of money in them, like whatever that is for you, $100, $300, and then you let that grow into a meaningful size position. Even when you're up 20, 30, 40%, don't trim or sell it because it's still such a small position for you. Hello, I'm from Malaysia. Hey, what's up, man? What's chime code? I said vibe code. So there's something people called vibe coding, and or maybe I was saying there's Claude code. People can vibe code away some of these websites. So I wanted to get to Keel Infrastructure. Yeah, let's check this out. I heard this one might be owned by Nvidia. I don't remember exactly, but let's go check this out right here. They have done phenomenal these past couple weeks here. Yeah, look at that. They've been straight up since this earnings report. It went from $1.70 to $5.70. So let's see what happened. So the revenue forecast is not good. If you look on the very left, the revenue was 83 mil. On the very right, it's forecasted to fall to 29 million. So that's odd. Revenue is supposed to fall. Net income is supposed to worsen as well. They're going from losing 13 to losing 40 mil. This is actually bad news. Huh. I mean, maybe there's some context I'm missing here, but yeah, revenue is going to decline and net income is super negative. So I actually don't see from a fundamental point of view why this stock has increased so much. So that's why I'm a little scared of this one right here. I just don't like that. Like Q3 last year was 83 mil. It's going to be 29 mil. I don't know about that. There's definitely something I'm missing here, but engages in building artificial intelligence data centers. So maybe it's like a CoreWeave, similar to CoreWeave or something like that. How long have you been investing? For 4 years now. Is this stocks? Yeah, we're looking at stocks right here. Next up. Oh, dude, what's your cost on CTRE? Yeah, I'll be quick about this. This is a REIT right here. These are cool. So my average cost is $40.56. I keep raising my cost basis. Like my original cost basis was, 37. Then I'm buying shares at 42. But anyway, what's cool about CTRE is, I'll be quick about this one. This is a triple net lease company. It'll impress you because if you are someone that likes dividends, by law, this company has to pay out 90% of its taxable income in the form of a dividend. So when this company has a 3.5% dividend, it seems abnormal. It's actually completely normal. And look at that payout ratio. It lines up to 85% payout ratio, 3.5% dividend yield. So out of all the companies that have to pay out all their earnings, I like this one the most because they have phenomenal revenue growth. Basically, think of this as MicroStrategy. So MicroStrategy issues shares and buys Bitcoin. This one issues shares and buys triple net lease healthcare real estate. And these triple net leases have phenomenal margins. Look at gross margins, 95, 98% gross margins, net margins of 50 to 80%. These triple net leases are just our money printers. So yeah, they've been raising their dividends for 12 years. Dividend payout ratio is an 81%, and their net debt to EBITDA is a 0.6. That's unheard of for REITs. They're always very highly leveraged. Like a Realty Income has a 5 times debt to EBITDA ratio, but this one's only a 0.6, which means they could pay off all their debt in 0.6 years. Can you check out Celestica? Yeah, hey, Drill, can you give me the ticker symbol? Yeah, if anyone has a stock you'd like me to analyze, please give me the ticker symbol. Oh my goodness, yo, are you still in your plasma? I forgot about Astera Lab. Actually, let me get to Astera Lab first. And then we'll look at what was the one I just pulled up. Anyway, Sterling Infrastructure. Yeah, that one's a cool one. They have a big backlog as well. So here's Astera Labs. And hey, thank you to everyone on the YouTube stream. Carlos, Riaz, Faker, Jerry, Plasma, Japan, Mike, I appreciate everyone that's here. If you are enjoying, please leave a like. I appreciate that. So here's Astera Labs. This is your data center communication company. Basically, if you have one data center on AWS trying to communicate data to another data center on Azure Cloud, they build the antennas for that infrastructure. And this has seen so much growth simply because of data centers. So basically, this is just a data center infrastructure stock, AI infrastructure, electrical infrastructure, and that's a huge sector I'm a fan of. You know, the picks and shovels plays, they don't have to be NVIDIA. But look at this. The revenue growth is like NVIDIA type growth. For the past 5 quarters, the revenue has been like 100% every quarter. So revenue went from 159 to 309. And not just revenue that grew, but net income as well. They're the most profitable they've ever been. The net income grew faster than the revenue, which what does that mean in English? Margin expansion. The same time last year, they had a 19% net margin. Now they have a 26% net margin. It grew 30% year over year. I have no bad things to say about this company, except they're a little expensive, but they deserve to be expensive. Look at this. I call this a fortress balance sheet. This is so impressive. Astera Labs has no debt. They're completely debt free. They have over, where's the cash? 1.1 bill of cash. And since they have no debt, they're actually earning interest on their cash. Where's this number? Yeah, they made 11.6 million of just interest on their cash this quarter. So that's why I'm a fan of companies with no debt, massive growth, massive free cash flow, net income, revenue growth. So yeah. Downgrade Northland Securities downgrades Astera Labs to hold on valuation and AI infrastructure spending concerns. So he says hyperscaler cloud providers may reduce AI infrastructure spending in 2027. Well, that's always, all right. All right, so let's keep going here. What was that other stock? Oh yeah, Sterling Infrastructure, another AI electrical infrastructure company. They basically do the complex electrical work for data centers. And that's a sector that's needed right now. So E-Infrastructure Solutions, check out the growth right here. This is why the stock isn't just at an all-time high because of momentum. The fundamentals have genuinely improved. At the very top, the growth rate is 173% year over year. I can't believe it. Last quarter grew 122% year over year. And so they crushed analyst expectations. The orange line's what the analysts expect from S&P Global. They expected 59 or 57 mil. They did 95 mil. And next quarter, it's going to get to 162 million. It's never even been close to 162 mil in net income before. So this stock is pricing in the 60% EPS growth that this stock is still going to experience. So what's the multiple? They are expensive at a 49 forward PE, but they deserve a high multiple. They really do have quality growth, DNA. So how are you, Nick? Good to see you, brother. What platform are you using for this? Hey, what's up, Catch the Fish? I'm actually on a brokerage. It's where you buy and sell stocks. They ask for a bunch of information, but if you'd like to get it, I have an affiliate link in my profile bio there, or you can just type it into Google. It's a brokerage called Moomoo, but I have an affiliate link linked up there if you'd like to help a brother out. If you end up depositing $100, we both get like a free stock. But yeah, next up, let's see. Yes, Sterling Infrastructure was a pretty cool one, Riaz. So Keel was Bitfarm. Are you serious, Faker? I did not know that. So Keel Infrastructure used to be a company called Bitfarms. I did not know that. So that was a Bitcoin mining company. Would you prefer Sezzle over Dave? Well, I bought Dave. So since I own Dave, I might as well just pick Dave. But both of those are extremely similar. And they're both very low multiples, even at all-time highs. So I'm going to just show y'all, here's how you can kind of tell when a stock is going higher. So, or first off, for context, I'll show you where I bought this stock at. So would anyone call me crazy? So check out this stock price right here. Would you buy a stock that would you buy it after it's rallied this much? Like you look at the chart, it was $4, a year ago. And after this huge gap up is when I bought it. It should show my buy order. Yeah, that's when I bought my shares. It just continues to climb higher. I can't believe it. So sometimes buying stocks at all-time highs really does still pay off. So Dave, here's the cool part. Even at this basically all-time high level, y'all aren't going to believe this. They're only at a 16 forward PE. This is not peak bubble, peak valuation, in my opinion. This could still stretch up to like a 20 forward PE before it fully maxes out. Why do I think they deserve a forward PE of a 20? Because they grow like a monster. Revenue organically is up 46%. And not just revenue, but profits. That grew 69%. They're the most profitable they've ever been, making 50 mil plus in net income a quarter and over 80, 90 mil of free cash flow a quarter. Look at the free cash flow growth year over year. Anywho, pretty cool company, 86% gross margins. Right now, already have net margins of 30-40%, excluding the one-time adjustment they had back here. They have like 40% net margins, so pretty cool. And Sezzle is another one that's very similar to that company. Hey, I'm glad this one's been recovering as well. So Sezzle, another one, is only a 20 forward PE. Funny, Dave is at a 16 forward PE. Sezzle's at a 20, a little bit more expensive. But Dave has rallied up more. Is Amazon a buy? Hey, what's up, Lulu? Good to see ya. With maybe a super Nino coming, El Nino coming, HVAC and power grid is gonna pay out a bit more. I agree. Instead of just owning Nvidia, so we all know Nvidia, they sell the chips. Instead of just owning Nvidia, in my opinion, buy the whole ecosystem. Buy the companies cooling down the servers that doing the HVAC work, which is Comfort Systems, or and a million other names as well. Buy the companies doing the complex MEP work, which is mechanical, electrical, plumbing work for these data centers because they need complex electrical work. Powell Industries, Sterling Infrastructure, these are great ones. Buy the companies providing the copper cables and the fiber optics. Amphenol, ticker symbol APH, they literally sell copper cables to Google and NVIDIA's for their NVLink Spine products. Also, in my opinion, buy the companies powering these data centers. I go with my favorite unregulated nuclear utility, CEG. They own 33% of all the USA's new active nuclear reactors. It's the purest play for nuclear. There is no close second. So that's kind of what my thesis is right now. Buy these AI infrastructure like picks and shovels plays that are not just NVIDIA. And by the way, Nvidia is a good deal, which some people's going to call me crazy. Like, look at this stock chart. Nvidia has rallied a ridiculous amount. Is most of the rally done? Honestly, I can't believe this. This is why we're not in a peak bubble valuation yet. The forward PE on Nvidia is a 20. What does that mean in English? They only trade at 21 times net income from next year. So next year's net income's a 21. That's how you really want to value Nvidia because they're a growth stock. You don't really value them off trailing 12 months net income. You want to somewhat price in this huge net income growth because it's going from 31 bill of net income to 57 bill of net income. So pretty cool. So what's up? Let's see. Japan said CMPS. Let's check this out. CMPS. And again, I apologize if I'm missing some people's stocks here. There's so many people on the stream today. I really appreciate it. If you want to hit the follow button, I stream every single Sunday at this exact same time. I literally sell nothing. I have no course, book. I'll never follow you, DM you. I promise. I sell nothing. Only thing I do have, if you want to help me out, it's a YouTube channel and a TikTok. Hit the follow button if you'd like. So here's Compass Pathways. This stock has done pretty good these past couple months. Looks like they're at a new 52-week high today. Maybe from the S&P 500. The S&P 500 is basically at an all-time high. They do have no revenue, so that's one thing to note. This is a startup, I believe, because if we go to revenue expectations, it says 0, and when we go to revenue, it says no data because this company has never sold anything, not a product or a service. So it's a biotech company headquartered in London. It's a biotech company, provides mental health care services. Oh, I think I remember what this company is. This is the psilocybin company. Okay, so you want to be really careful about this stock. So they're trying to treat depression with, I don't even know if I can talk about that on TikTok. So anyway, they're not headquartered in the US and they have no revenue yet. So would I really trust this company? Would I put my hard-earned money into a stock that has no revenue yet? No. And they lose a lot of money every quarter. They're losing 40 to 50 mil of net income a quarter. So it's a tough one for me, but the stock has done great. That's the weird part. Stock has done great. Maybe they had some, actually, you know what? Look at this right here. You see this day right here? There was no earnings. So I suspect maybe this day they're like, hey, we just got FDA approval. We're now finally able to sell something. We gave guidance 1 year out for some revenue. See, I just don't know without that context. So hopefully that was kind of helpful there. Oh, hold up. Watch out for these people in chat here. Okay. Next up. Okay, Luke, can we check out CLS? Yeah, let's do Celestica. This is another data center infrastructure company. And unfortunately, a lot of these AI infrastructure stocks have rallied too much, so you don't really buy these today. But, tech is going to dip again. And when tech dips, it dips hard. And usually ones with high multiples like this one, you put this on your watch list to buy the dip on. So check this out. Actually, let's see. Is there an earnings recap we get here? Okay, cool. So their connectivity and cloud segment led growth with 76% revenue increase, driven by strong data center and AI ML demand. So it's a data center stock. Obviously, that's a huge sector that's booming right now. Advanced technology segment revenue remains stable, showing no significant change year over year. Well, anyway, they're at a 37 forward PE, falling from their 47. So they are supposed to grow their net income. So basically, look at the revenue expectation. Revenue is going to go from 3.2 on the left all the way up to 4.9. And net income, they might have had a one-time adjustment. So I'll basically just look at EBIT, just removes the one-time adjustments. The earnings before interest taxes, it's going to go from 240 to 402. So there's still a lot of growth happening for this stock. Yeah, that's actually really impressive. Yeah, revenue's up 52, profits are up 101. That means margin expansion. So net margin actually grew 61% year over year. Okay, so yeah, I can see why the stock has done so well. It's not just, momentum, it's the fundamentals are genuinely improving. Their profits this quarter grew 101%, 56, 137, 98. They really are growing their profits and their bottom line. What platform? Webull? No, actually, I do have Webull though, but no. Yeah, here's Webull. This is my favorite brokerage of all time. Lowest fee, cost nothing. If you'd like to get this brokerage, it's where you buy and sell stocks on. Actually, I have it linked in my profile bio there. It's a brokerage called Moomoo, but you can just type it into Google. But if you'd like to use my affiliate link, I do have a link up there for affiliate link. So, hey, what's up, Last Resort? Hope you're having a great Sunday. Hope everyone is. So, good morning. Do you see MCK as a value stock or too risky? Let's check out McKesson. Okay, this is a medical delivery company. I actually don't see this one as too risky. I do like this stock. They are on a bit of a dip right here. So they missed on earnings and they gapped down. Let's go specifically look at their earnings report. So they are cheap. I mean, 18 forward PE. I mean, the S&P is at like a 21 PE. So they're cheaper than the S&P 500. North America Pharmaceutical. They're also in oncology. Actually, let's check out if there's like an earnings recap. No, there's not. Okay, that's fine. So this is a historically very low margin business. If we just go to net margin right here, if we just zoom out, this is a 1% net margin every quarter, 1.9, 1.1, 1, 1. So they historically have a 1% net margin. So, they do 100 bill of revenue a quarter, and then they keep around $1 billion to $2 billion of that. But that's all they need. All they need is that 1% net margin, and that's $1 billion of net income for them. So they are a bit leveraged. Yeah, I don't really have any complaints about this company. It looks like they did miss on revenue. This is probably why the stock. So as we see right here, the stock fell on this day because that's the same day they reported earnings. This might be why. If we go to the analyst forecast and what the analyst expected them to report this quarter, the orange line's what the analyst expect. They expected 101 bill. They did 96 bill. So that's like a 7% miss on revenue, the top line, which is no big deal, but that the worst could already be priced in. You know what I'm talking about? Ooh, I'm seeing some really good ones. Big thanks just for what you do. Hey, Lashon, I really appreciate those kind words. Thank you very much. So I am behind, so I apologize. I want to get to next up, because I saw this one for a while. Palantir, I know it's a kind of popular one too. So, and I see Credo. Oh yeah, remind me to get to CRDO, Credo. I'll definitely do that one. How often do you go live? I try and stream every other day, or try and almost stream every day, but every Sunday at this exact same time. So here's Palantir. This one should benefit. If we see more geopolitical conflicts, this one should actually benefit. Palantir experiences gamma squeeze with 231 million institutional inflow. Okay, well, that's just... Okay, well, let's go judge this company off their fundamentals because that's what matters. And I am so impressed with Palantir personally. Half of their revenue comes from their government. So many police stations, the military, the Air Force, all use their software. And this revenue is the growthiest on the entire screen. It's up 76% this quarter. No other quarter has it even been close to that growth rate. Literally, the growth rate is growing on Palantir. So I'm very impressed with that. And it's not just their government revenue that's growing, but the other half of the business, the commercial side, is growing even faster. It's up 95% year over year. Holy moly. And this is organic. Like, they didn't acquire a company to get these growth rates. This is organic revenue growth. And they crushed analyst expectations. Analysts expected 616 of net income. They did 870 mil, which is a 53% net margin. As you know what the net margin is. If you spend $100, you spend $100 with them, they keep $53.68 after paying taxes. And that's the highest net margin on the entire screen. So they're expanding margins. The net income's at a record. The organic revenue's at a record. And they have a monster balance sheet. They actually have zero debt, completely debt-free, over $8 billion of cash. Notice their cash pile grows every quarter because when you make all this net income and free cash flow and you have no debt, you don't owe anyone any money. So you just retain all this money and, they earn interest on it. So I'm a huge fan of Palantir. It's just too hard to buy after this huge rally. It's too expensive. That's the only bad part. It's too expensive. Hey, Golf and Philippos or Vinny. Sorry if I'm saying your name wrong. Thank you very much for those gifts there. If you have a stock you'd like me to look at, definitely let me know. which website, or I'm actually not on a website. This is a brokerage, where you buy and sell stocks. They ask for a lot of information, but I actually have it linked in my bio profile there. You can just type it into Google though, or the App Store brokerage called Moomoo. But if you'd like to use my affiliate link, I do have it linked up there. So CRDO, this is one of my legit favorite stocks. And it sucks that they're at an all-time high right now, but they deserve to be at an all-time high, and you'll see exactly why. This company, they sell, they sell to NVIDIA. They sell fiber optics and copper cables to NVIDIA's products, and they're competitor to Amphenol. Sorry. So look at the revenue growth. This is organic. The revenue's up 200%, like the past 5 quarters in a row. The green number at the bottom is the year-over-year growth rate. So the revenue grew 201% year-over-year. So the revenue's up 201. The net income is up by 440. What does that mean in English? Margin expansion. The net margin went from a 21% to a 38%. I cannot believe it. That's the recipe for a stock hitting an all-time high and just being a multi-bagger. All these qualities, insane revenue growth, insane net income growth faster than the revenue. So that means margin expansion, printing free cash flow, 3,000% free cash flow growth. And it's another company that has no debt. There's a trend. There's a reason, a lot of these stocks are expensive. They all have similar like DNA qualities. No debt, great revenue growth, free cash flow, money printers. So in a great industry, data center, AI infrastructure. So pretty cool company here. Credo Technologies. I also really like Amphenol stock, APH right here. This is the one I've been loading the boat on. Cool. Dang, Lopez, you got 750 shares of Credo. You are definitely a happy shareholder then, because they're basically at an all-time high right now. So super congratulations. You earned it, especially for not selling before today. Have you heard of SIVE? Thesis is that in the future, so much electricity will flow through data centers that copper is not enough. This company does DFB lasers, transferring information through light, or SIV. Oh, like fiber optics. The Amphenol is getting into that too. So here's Sive Semiconductors. So basically what they're saying is, with copper cables, there's a bit of a loss of electricity the longer the cable goes. For short-term cables, they're going to continue to use copper, but for super long-term cables, they use fiber optics and other ways like light. It operates through wireless and photonics segment. Wireless segment includes development, manufacturing of chips, components, modules, and subsystems based off 5G millimeter wave technology. The photonics, design, manufacturing. Okay, well, let's go to their website. Maybe we can get a better idea. They're headquartered in Sweden. So, but here's their website right here. Our products, wireless, photonics. Well, let's just go to their wireless business. Maybe they... I'm trying to find out like some actual, maybe they do like they help out fiber optics for internet. Anyway, let's check out the revenues here. So wireless, photonics, most of the revenue comes from the United Kingdom. That's half of their revenue. 32% of it comes from the United States. 10% of it comes from Poland, and then some other companies as well. So that's interesting. Do they have revenue? They do. So they didn't have, that's the bad news. So we have converted the currency from SEK to USD, and they only did 8.8 million in revenue. So this is just a very small company, but do note that is record revenue. This is the highest revenue of any quarter in their history. Are they profitable? So they're not profitable yet. They're still losing 5 million of net income a quarter. So they have a good balance sheet though. So they're fine. They're definitely not going bankrupt. But yeah, this is a recent IPO. So there's not too much data we get here, but it's a 10x since its IPO. Since March, it's a 10x. It was $1. Now it's $7. So that's crazy. Just since March, just a few months, it's like a 9x. Oh yeah, let's do Symbiotics. So SYM, this is the Walmart company I was talking about. So Walmart just gave huge CapEx guidance saying they're investing in robotics for their fulfillment network. And here's what they do. Oh yeah, we'll look at you after this. What company do you see having higher multiple expansion that you'd like? Oh, Amphenol is one of them, Samir. I'll try and answer that better in a second. What website software are you using? Yeah, it's actually a brokerage. It's a, application. I have it linked in my bio actually if you'd like to check it out with my affiliate link, but it's a broker called Moomoo. If you end up depositing $100 through my link up there, we'll both get like a free stock as well. Anyway, my favorite brokerage, it's free, costs nothing. I also have Robinhood and Webull, but Moomoo is the best one in my opinion. Best for analyzing stocks, no fees. Like with Robinhood, they make you pay $5 a month for a lot of the features. There is no way to pay this company any money. It's completely free. There is no monthly subscription. And I love all the tools. So anyway, here's Symbiotic stock, the robotics company. If you're a fan of robotics and you think robotics are the future, in my opinion, this is one of the best stocks to buy, not financial advice. They specifically help out warehouses. Oh yeah, look at that. 80% warehouse labor cost reduction. I want to show you some of the actual like robots in use. I bet they changed their website a little bit, but their biggest customer is actually Walmart. They have like Albertsons, a lot of grocery stores are their customers. Yeah, here's the CEO of Walmart giving their recommendation to Symbiotic. Yeah, the main video is at the top here. Basically, if you've ever seen like the Amazon warehouse robotics stuff, oh, this might have sound and get me in trouble. Okay, good, it is muted. Can I like skip through it? Anyway, they have over 1,500 patents. So I want to own a robotics company that's not some startup with no proprietary patents or anything. I want to own the one that has incredible revenue growth like this, where the revenue just hit a record. Something I can actually trust. There's real revenue growth right here. And real customers. If we go to the shareholders here, Walmart owns 11.8% of all the shares that exist. So Walmart's a big shareholder. So Walmart's their biggest customer, and they like them so much that they bought their own shares to get exposure to the robotics. So they're on a dip right now, and I think it's because they're overvalued, and they just did some share issuance. They diluted shareholders by $1 billion to raise $1 billion of cash. But yeah, when we look at this forward VE, so at least they have a forward PE. That means they're profitable. But it is expensive, at a 58. So, but technically, it's like cheaper than all the other robotic stocks. It's cheaper than Rich Tech Robotics. It's cheaper than Serve Robotics, and I'd own neither of those. All right. Would you buy Copper? Hey, what's the ticker symbol for Constellation Software? I've heard about that one. They're called a serial acquirer, where they acquire a ton of businesses. So Innodata. So I'll be quick about this one. Basically, they're at an all-time high right now. Even at an all-time high, they're only worth $3.4 billion. So that's still relatively small in my opinion. Basically, the reason they rallied up so much is because if you look at the third line here, a new big tech client, which is Palantir, secret revealed, Palantir is expected to generate $51 million in revenue, becoming the company's second largest customer. The cool part is their main customer is Google, then it's Meta, then it's Amazon, then it's Nvidia, then it's Microsoft. I missed Palantir right there, but Palantir is a big customer as well. They technically had record diluted EPS this quarter, fortress balance sheet. I wouldn't buy the stock today though. That's the only bad part. But yeah, they crushed expectations. Look at this. Net income expected was 2.8. They did 14 million net income, and that wasn't like some funny money one-time gap adjustment. That was genuinely real. Here's the EBIT expectations, which is earnings before interest taxes. They expected 3.6. They did 16. They really beat on the huge beat on revenue too. So they beat on their bottom line by like 500%. And that's what led to the stock to have such a monster rally. So I own shares of this company. It's not much. I put $300 into the stock, and it's grown to now $1,000 position for me, which is pretty cool. But yeah, since it's still only $1,000 position for me, I'm not selling or trimming any of my shares. So someone's been saying, can we look at Path stock? Yeah, let me do Path really quick. And hey, shout out to member Marks. Dude, I appreciate you, man. Yeah, we'll look at Salesforce after this. So another Salesforce kind of type stock, UiPath, I am down bad. So as we know, a lot of software is getting squeezed right now. You look at an Adobe, a Salesforce, a UiPath, and a Duolingo. So I am down bad on UiPath. I've owned this stock since 2021. I can list every sort of bad thing they've ever. Look at my buy orders back here. Oh my gosh, dude. Fully transparent. I was buying shares at 50 a share. There's my buy orders basically right after their IPO, and I have been holding a bag ever since. I can list every bad thing from the CEO cash grabbing, quitting out of nowhere, leaving the management for dead, to cutting guidance. But they just reported some results though. I actually have not looked at them. So let's go see. Someone said they just got GAAP net income positive for the first time. Let's check it out. So net income this quarter, they beat on revenue. They expected 397. They did 420. They made 22 million net income. So yeah, actually, they finally are really net income positive. At least for the past 3 quarters, they are. So these year-over-year growth rates, they've really narrowed their losses. Yeah, I'm actually impressed with these getting to net income positive. Let's see what the earnings recap is right here. I would be curious. Oh, there is none? Well, do we at least get like an AI analysis down here? Okay. So yeah. Results 17% revenue growth, achieves first GAAP quarterly profit since their 2021 IPO, raises their full year guidance. Annual recurring revenue grew 12%. Anything else? AI products. So yeah, okay, there's no EPS guidance they gave. Oh, watch out for that person in chat there. Yeah, never click those things. Luckily, this Astai guy I'm copying, I have a guy now. Since this guy's a for sure scammer, I copy his username and I can promise you he will be fully banned off TikTok. See, I got someone at TikTok now. I feel lucky because it feels good getting the scammers permanently banned. But anyway, here's UiPath right here, though. There's still here's the tough part. I don't know if this is true, but even on this huge dip right here, even on this massive decline, they're still at a 33 forward PE, which does still make them expensive. And I'm I have just had such a bad experience holding UiPath. I'm probably just biased toward the downside, and I'm a shareholder. I want to see them do good, but I'm down 44% on them. It's not that's not a quality software company. There's a few software stocks that I have been buying. I've been avoiding buying more UiPath. The software stocks I have been buying that I think are quality have been Reddit. It has been AppLovin. It's been Microsoft. It's been Uber. These are the actual software stocks I recommend. So let's do Salesforce. Thanks again. Shout out to member Marks. I appreciate you, man. Hope everyone's having a great Sunday, by the way. Hope great weekend. And we'll look at ServiceNow. And I see best or is that BlackBerry stock? Yeah, we'll look at BB, Futu. Again, I'm trying to get to all these. I apologize if I'm behind. So here's Salesforce right here. They just did something incredible. A share buyback that I've never seen before. An insane share buyback. So, or I'll just go to the cash flow statement and show you yourself. You go to the cash flow statement and you look at net issuance retirement of stock. You want this to be negative. That means they're buying back their own stock. They just bought back $28 billion of their own stock. They spent $28 billion of their cash pile buying back their own stock. It kind of leveraged up the balance sheet. Look at that. The asset to liability ratio is a 47. Now it's a 67. But here's what share buybacks do. If you go to net income growth rate, net income grew by 36% year over year, but the net income per share grew by 52. So how did the net income per share grow faster than the net income? Well, again, it's the share buybacks. It's the share part of the ratio that went down. So each share is technically you get more net income per it. So the net income grew 52 versus the net income growing 36. That's the power of the share buybacks. And that also makes the cost of the dividend go down. Let's see if that's already taken into effect. Usually it takes 1 quarter after, but let's see. Yeah, look at that. Whenever you buy back your own shares, you don't pay dividends to those shares. So how did the cost of the dividend go from 390 to 365? Did they cut their dividend? No, they bought back their own shares. So I actually liked that share buyback that they did. They bought their shares basically at, what's the multiple today? They bought all their shares back at a 21 forward PE. So 21 times net income. Pretty cool. They still have a really good RPO, which is basically contracted backlog. They're owed $72 billion. How was the free cash flow this quarter? 6.5 billion of free cash flow. Q1 is always their best quarter every year. They just consistently make 6 billion of free cash flow every year the same quarter. 5 bill last quarter, 2 bill. So this is still a good software name. Not one I'd go crazy in. I wouldn't have this as like a super meaningful size position. Salesforce Agentforce AI business surpasses 1.2 billion ARR with 205% year-over-year growth. Processes 28 trillion tokens. CVS expands Salesforce partnership. Well, cool. And they've rose their full year guidance. Okay, that's pretty cool. Q2 guidance of revenue guidance of 11.3. Okay. Well, anyway, that's Salesforce right there. Hopefully that was kind of helpful. They also pay a dividend. They own Slack. If anyone's heard of Slack before, Amazon uses them. The Slack business is like the growthiest business, actually. Oh, they've changed how they broke down their revenue. So look at this. They've really rebranded for their Agentforce. So they used to break it down from service, sales, platform, integration, analytics. Now it's just like they've like combined all the segments to just like Agentforce apps and Data 365. Anyway, interesting there. That's Salesforce. They're probably still want to be careful because software is still kind of with debt. Check Salesforce. Are they buying back the shares with debt? Well, yeah, basically. I wonder how their leverage ratio is. I'm sure the leverage is fine because let's just go to let's see. So they have current debt, or actually, yeah, 4 billion of current debt. And yeah, look at their debt. So remember how they bought back 27 billion of their own shares? Look at their debt. It basically went up by 27 billion, or actually went up by 28 billion. So they now have 40 bill of long-term debt. Luckily, it's not impossible to pay off because they're making 2 billion a quarter. Dang, couple bill of free cash flow a quarter. But yeah, that's kind of they did what Monster Beverage did a long time ago. They bought back a ton of their own. They leveraged up their balance sheet a while ago and bought back like 10% of all their shares, but it paid off. All right, next up here, I love companies that do share buybacks for sure. What do you think about Samsung? Yeah, I can't view their stock, but that's your memory shortage company. Samsung is in the RAM. Where are you seeing all this on? Oh, hey, yeah, Alan, this is a brokerage. It's where you buy and sell stocks on. I have it linked in my bio, linked in my profile there if you'd like to check it out with my affiliate link. So let's do CrowdStrike. This is a cybersecurity company. Out of all the software sectors, like there's some part of software I'm bearish on, like a Duolingo. I'm worried about Duolingo. Um, but this is a part of software that you're not going to vibe code away your cybersecurity Salesforce or CrowdStrike platform. So this is your cybersecurity play, the best one there is. Over half of the S&P 500 are customers. It's a huge subscription model play, and I love subscription model companies. So do analysts. It's all reoccurring. It's predictable, and let's check out how that's growing on an annual basis. Check it out. That's what you want to see for a stock that does no dividends and slightly dilutes you. You want to make sure they're growing like a beast, and they are. So here's their annual subscription revenue. Full year 2021, it was 804 mil. Now it's 4.5 billion. I'm really impressed with this. They're also really free cash flow positive. They are still kind of struggling with net income positivity because they are still paying out lawsuits from their the update that bricked every Windows computer about a year and a half ago. They used to make net income. The reason they went back net income positive are these lawsuit payouts. It was a really big deal back then. Literally because of this, if you got their update like Delta Airlines did and all the airlines did, um, it bricked your PC and you couldn't reset it. It was completely broken, and every single airplane in the sky had to land that day, and it caused huge ripple effects. And that was just one little example. It shut down every airport in the United States. Every single aircraft in the whole entire sky had to land at that moment. I made a TikTok that day. It was pretty crazy. I showed the air traffic. It's a really old TikTok if you want, and YouTube short if you want to try and find it. But what's your opinion on Zscaler? That being said, though, would I buy them at all-time high? No, I would not buy CrowdStrike at all-time highs, but I would put them on the watch list to potentially get into. Oh, let me do BlackBerry. I'm so sorry. I said I'd get to that one earlier. When we think of BlackBerry, we think of those smartphones. Here's the stock in the year 2000. It was a $200 stock. Now it's a $9 stock. They've lost the smartphone war against Apple, but they have converted into like a software, like automotive software company. So actually, Morningstar says they're overvalued despite a streamlined portfolio and dominance in niche automotive software, inflated operating expenses, intense competition from well-capitalized tech giants, and the long runway needed to generate durable economic profits require caution. So that's one thing to keep aware of. Morningstar saying be cautious, but the analysts are pretty good. They are making good net income positivity. Next quarter, they're supposed to make 11 million, 15 million the quarter after. So I'm assuming they're going to stay net income positive for the rest of time, because before today, the net income was quite choppy. Actually, they were losing net income every quarter. So if they can consistently stay net income positive from now on, that would be a huge win in my book. Yeah, they beat on revenue for the past 3 quarters in a row. So if they can just continue to keep beating on expectations, that'd be great. But it's not cheap exactly. A forward PE is a 60. And from a technical point of view, they've had this massive momentum rally these past couple weeks. So maybe there's something to this. I don't know if there's some news I'm missing. Let's see right here. BlackBerry announces buyback program. BlackBerry secures FedRAMP recertification for ad hoc critical event management platform. The company states ad hoc is trusted by 80% of U.S. federal agencies for crisis communication and incident management. So yeah, they're not a smartphone company anymore. Some other software communication. I don't know. What is CLH? I don't know what that one. Oh, Clean Harbors. Is this the one you're talking about, Riaz? This is a really cool company. So they basically clean up waste whenever there's a fire on the road or biochemical spill, like that huge train incident that happened in Ohio where the train spilled a bunch of hazardous oil and stuff. Clean Harbors is the one that came and cleaned that up. They also do something called battery disposal. Did you know if you throw away a Tesla car battery, it costs over $2,000 to $3,000 just to throw it away apparently. And this is the company that handles that as well. So they do environmental services, safety, clean sustainability solutions. I used to own this company. How do I know so much about them? I used to own them. I regret every share I've ever sold. I regret the shares I've sold. Wish I could get back into this company. But yeah, it's just like you can't get replaced by AI. This like AI proof business model here, cleaning up just waste. So really, really cool company. Cleaning up pollution, call it. They're a little pricey though, or 32 forward PE isn't ridiculous, but yeah, here I'll show you. Here was the last time I owned shares. This is sad. Let's see. It's in my dividend account. CLH Clean Harbors. The share price today is 281. I had shares at dang 113. I sold my shares at 113. How sad. I'd be up double. And that's why you want to buy and hold your stocks for the long run. I've been seeing IBM. Let me do that one. I regret not buying the dip last month. Hey, MC, I'm sure you'll get another chance in the future. Um, what's the company again? That was Clean Harbor, CLH. So here is IBM. Yeah, hey, what's up, Looney Zone? I hope you were having a great Sunday. Shout out to member Looney. So this is IBM. They just received $1 billion from the U.S. government. The U.S. government did some, quantum chips. Oh yeah, Chips Act, Quantum Act, something like that. The literal U.S. government invested $1 billion into IBM, like a couple hundred million into QBTS and some of these other quantum names. So out of all the quantum stocks to buy, this is honestly the best one. You know, Google, Microsoft are another two, Honeywell or some other good ones, but IBM's a really good quantum company. I definitely buy this one over like a QBTS and RGTI. Don't buy those ones. Yeah, you buy IBM right now today, you still get 2.3% of your money back just in a qualified dividend every year. So you're getting a very nice dividend. This multiple isn't like ridiculous. They're only at a 29 forward PE. I don't think that that's peak bubble valuations. I think that could still go higher. They are still exposed to AI via this software. The reason before that quantum news, the reason the stock has fallen before today, before the news recently is because of their software business. You know, it's kind of being hurt by AI right now and kind of just following the momentum of all software stocks like a Salesforce, a ServiceNow. So IBM's similar to that with half of their revenue coming from software, but I still really like IBM. Nice dividend growth stock. So let's do Zscaler. Yeah, so Zscaler just had a massive drop. Oh, they did recover on Friday. They're up 7.5%. But let's find out what happened here. I don't actually know. So AI security, data security drove strong top line growth, securing 450 enterprises ahead of schedule. The Z-Flex program generated over 175 million in total contract value. Free cash flow increased 41% with a margin of 52%. So here's the thing. They have good free cash flow. So look, they're free cash flow positive. They're making 130, 100, 200 mil of free cash flow quarter, but they lose net income every quarter. Why is that? That's because they pay employees with stock. And whenever you pay employees with stock, that's subtracted from GAAP net income because you would have had to pay those employees with actual cash, but you're paying them with stock instead. So that's whenever you pay them that way, that's removed from net income. So all they've done since IPO is technically just lost net income. That is the one thing that is kind of bad news about this stock. They're not net income positive yet, but they are kind of getting close. But the losses have worsened year over year for the past 2 quarters. You know, they were really close. They only lost 4 million. Well, now they lost 13 million. They're back going in the wrong direction, losing more and more money, but they have phenomenal revenue growth. I'll give them that. This is what you want to see. If you're going to own a stock that, you know, loses net income every quarter, you want to make sure they're growing, and they're growing insane. Revenue's up 25% year over year, literally to a new record. It's never even been close. It like hits a record revenue by the quarter. But let's find out the news here. So multiple analysts cut Zscaler targets, citing fiscal 2027 growth deceleration and sales leadership concerns. Guess that's not good. Okay, so 2027 guidance implying 16% growth versus the consensus of 18.5%. So they missed on guidance. Okay. 2 law firms launched security fraud investigation into Zscaler over potential misleading statements regarding financial metrics and executive departures. Well, anyway, it looks like there's a balance of news here. The tough part is there is no forward PE. There is no way to like value this one off some like next year multiple. So I would want to be careful with that one. So let's do Futu. Yeah, actually, good question here. How do you feel about Futu? If you're wondering, what is this stock right here? This is actually the app I'm on right now. So this literal brokerage software application I'm on right now, the stock we're looking at is this app I'm on, publicly traded. If you look at the very top left, this brokerage stock is called Moomoo. And if you look at the very top middle, this app I'm on is called Moomoo. So hey, this is literally this app I'm on right now, publicly traded. I love this company. They're a money printer. Revenue grew 23%. Profits grew 30% year over year. So here, if we just zoom out, here's basically the profits every quarter. They're the most profitable they've ever been, making like, and this is in US dollars, making now 500 mil a quarter. But why did this stock fall down right here? It's actually because 17% of this company's revenue is their mainland China customers. So they're an international brokerage. 17% of their total customers are mainland China. And basically, they just got fined for allowing people in China to buy US stocks. So they allowed people in China to buy US stocks and they got sent a fine for it. But they actually just repurchased $418 million of stock just in the past week here. And that's actually, we did the math earlier, that's over 3% of the entire company. So the stock just bought back 3% of all the shares with that $400 million. And again, $400 million, that's 1/4 of profits of net income. So nothing to be worried about here. I actually bought the dip during this time. So it wasn't just Futu that fell as well. TIGR stock fell a bunch as well. But yeah, down here on this day, I did end up buying 5 more shares at $89 or $90 a share. And it's 104 now. I will be looking to add more to my position, especially if it falls. So I am down 15% on that position, but it's just kind of like an alternative to like a SoFi or a Robinhood, which I do own. I'm a big fan of the whole fintech industry. I got SoFi, I got Robinhood, I got Futu, so I got Dave. All right, so I'm so behind. Hey, what's up, Michael? I hope you're having a great day. Look at GPN and FIS. All right, let's check out global payments. And Intuit, we'll look at I'm really behind, so please forgive me here. I appreciate everyone that's here though. Hey, what's up, Dexter fan? What's up, man? Which website is that? Yeah, hey, again, this isn't a website. I'm on a brokerage. It was called Moomoo, and I have it linked in my bio, actually linked in my profile. It's an affiliate link, so if you'd like to help me out, we could both get like a free stock if you sign up with the $100, but you don't even have to. It's a free app. So here's GPN Global Payments. So unfortunately, this stock has the same price that it was back in 2016, so they have been struggling for a decade. They are cheap though, or 16 forward PE. So they're trading at 16 times next year's net income. Looks like they had a one-time adjustment this quarter. It says they lost 1.8 billion in net income when analysts were expecting 230 mil. So, but the EBIT, earnings before interest taxes, was positive 1.14 billion. So I'm assuming they had some one-time gap adjustment making their net income go negative because, well, the operating profit was barely positive too. Maybe they had some lawsuit payout. I don't know. I kind of need to know the context there. Maybe it was an acquisition fee. Or, I mean, they just sold off an asset. Maybe it looks like 5.7 billion cash from investing activities raised. I don't know if they just sold off an asset or something, but if we just look at the forecast, they're supposed to make 370 mil next quarter, 370 million the quarter after. So they really do just make a good bit amount of net income every quarter. 16 forward PE might be fair. You get a 1.3% dividend yield, 17% payout ratio. So let's go to their website. Maybe we can see if this is something that maybe can be out innovated. Take payments anywhere, anytime with payment solutions designed for your business. So yeah, kind of like these, checkout screens where they're like, hey, would you like to leave a 1,000,000% tip or something? Yeah, like these toast. Oh my gosh, why did that scare me? Yeah, these things, you've probably seen these before, Anyway, let's go see what the revenue is. Or wait, we kind of just saw that right there. Revenue is, 2 billion a quarter, but this quarter it was 2.97 billion. I am wondering if maybe they recognized a gain from selling out of an asset. I don't know. Anyway, I'll get off this stock. Hopefully that was kind of helpful there. Hey, Tangrico, hope you're having a good Sunday. Does Palo Alto Networks beat this week? That'd be a good question. Yeah, that was not a Duolingo notification. That was just like their website, but it did sound like that. Yeah, I don't even have Duolingo, so I don't know. I have notifications turned off. That scared me. Hey, Tariqa, thanks again for the 22 roses. I greatly appreciate that. So ASTS Space Mobile, they did report earnings and miss on it, but they did give some good future guidance. So basically, if we look at revenue forecast, analysts expected 36 million this quarter. They did 14 million. So they did miss on earnings, but that's no big deal. This was still the best Q1 in their entire history. If we zoom out, this company used to just do $1 million in revenue a quarter, a tough buy, but now they're doing a lot more, 15 mil, 50 mil last quarter. And check out the future forecast. The revenue is supposed to hit 51 million in 2 quarters. But they are still supposed to lose 100 mil next quarter, 115 mil the quarter after. So the bad part is they're still supposed to lose a lot of money. So they're not profitable yet. So it is kind of tough to value this one because there is no forward PE. And market cap is 34 billion. I do think this stock has had a lot of positive momentum simply because of the SpaceX IPO and the Artemis mission, like Artemis 2 mission launch. Like all these space stocks, not just ASTS, but like a Rocket Lab, they're all pretty overbought, and I would be cautious. But I do like the top line growth. Are you looking to buy anything this week? Yeah. So basically, these are the 3 stocks I'm kind of liking right now. Netflix, this is the first stock we analyzed on the stream. We deep dive into Netflix, Uber, and Lowe's. These are the 3 stocks I'm looking to get more of this week because they're still cheap. They're still, even though the market, if we look at the S&P 500 right now, even though the market is basically at all-time highs, I do think there are still some deals out there. Yeah, like who's buying the indexes at an all-time high? It is definitely hard. So a lot of the holdings and a lot of the main components of the S&P are also at all-time highs, but there are some that aren't, kind of like a Netflix, which I think is a great advertising company. All right. So, oh, did I look at the wrong stock? Okay. Dexter said SoFi, and I'm so behind here. Credo and Astera Lab, I feel, are getting too expensive. Yeah, they are really expensive. Brandon said PSIX might buy the dip. Yo, actually, this one's a cool one, but they did just have some bad numbers. And hey, please Dexter, please remind me to get to SoFi. Say SoFi again, and we'll check it out, or we can do a different one. So here's Power Solutions. They help out. They help out with electrical power work, and if we go to the forward PE, it's still not super expensive. A 16 forward PE. The S&P 500 trades at like a 21 forward PE. So, we're definitely cheaper than the S&P 500, but they did just miss on expectations and the growth went negative. So the revenue actually declined 5% year over year. So the organic revenue, the lifeblood of the company, declined 5%, and the net income actually declined 61%. So what does that mean? That means margins are going down. Luckily, they're still net income positive every quarter, but that's just really not a great sign. Looks like the growth has maybe peaked or something with the revenue now negative and net income falling as well. They're still going to stay net income positive. They're going to make 7 mil next quarter, 20 mil the quarter after. So they're still at they're only a $900 million company. Reminds me of Powell when I first bought them. This company's only worth 960 mil. They're at a 16 forward PE. But I just like how they're net income positive every quarter. So let's do SoFi. Then we'll get to SATS. Remember to get to SATS as well. I definitely don't want to miss out of that one. Okay. Ooh, watch out for that person in chat there. Okay. MicroStrategy, yeah, that one's like a leveraged Bitcoin. So here's SoFi. This is a great fintech stock. I do own this one. I own them for a reason. I believe in the growth story. I don't have it as a really meaningful size position, but I still have it as a position because I like the company. If we go to their main lending business, SoFi does loans, that grew 55% year over year, the highest growth rate on the entire screen. So that's impressive. It's good to see that their main business is super growthy. And also their other half of the business, the financial services, that grew 42% year over year. After grew 101, after grew 85, after grew 244. So they're on an incredible streak of growth. So when you own a stock that slightly dilutes you and doesn't pay a dividend, you want to make sure they're growing really nicely. And SoFi is. Organic revenues up 42% year over year to 1.1 billion revenue. And on that revenue, they didn't just lose money. They actually made profits on this. They made 166 million of after-tax net income this quarter. And the analysts are still super bullish. In 2 quarters, the net income is supposed to hit 240 million. It's never even been close to 240 million before. So that's why it's really still a growth stock. And you really want to value them off next year's PE. So they only trade at 25 times next year's net income. For a stock growing like how they are, I personally think that's cheap. That's why I even just picked up a new additional share of SoFi. I wonder if I can pull that up real quick. SoFi, I bought it just a couple days ago. It used to load my buy order. I guess it doesn't want to load my buy order anyway. I just bought a share a couple days ago. All right, so next up here, Hey, what's up, Austin? Zoetis got to be oversold, right? Maybe, yeah, from a technical point of view, Zoetis is probably oversold. Look at this massive gap down. They fell 20% this day and have just slowly bled down ever since. This company had a slowdown of revenue. So this is a pharmaceutical company specifically helping out animals, pets, livestock. So if we go to the revenue growth rate the past 5 quarters, this is one of the tough things. The growth is slowing down. It's kind of like doesn't beat inflation. Revenue's only up 2.9. Last quarter's up 3, 0.5, 4, 0.3. So kind of low single digit revenue growth. So the revenue improved 2.9, but the net income actually declined by 0.1, which did mean the net margin fell by 3%, but still no big deal. They're still printing every single quarter 6 to 700 million of after-tax net income every quarter. So they're not going bankrupt, but I don't think analysts are happy about super slow revenue growth, even negative margins, negative net income now. So that's why I think Zoetis has fallen. But I think at this point, like the worst is priced in, at an 11.7 forward PE. That's cheaper than oil stocks. That's cheaper than Chevron. These are like commodity multiples. 11 forward PE might fully price in the worst. So yeah, they're in parasiticides, dermatology, pain and sedation, all for animals. They're an animal healthcare company. And they have a cool, there's this investor presentation that they have where humans would rather like spend their last $100 on their pet. Investor relations. Okay, I'm gonna find that metric really quickly because latest presentation. Actually, maybe we can't because it'll take too long, and I don't want to bore anyone with this. So, somewhere on here. Here's their guidance right here. Organic operational growth, so 2 to 5% revenue growth. So yeah, maybe bad guidance right here. Here's, I guess, all their products. It's probably not in this presentation right here, but they had some metric that like, I'm not even gonna find it. Anyway, let's see. DXYZ, what's up, Stocks Crypto? Oh, Eric said AppLovin. Yo, AppLovin, I love that software company. DBSBY. Let me get to this one. DBSDY. Hey, I found that one. Hey, Emperor Penguin, how's it going, man? So let's see. This is an ADR stock right here. They're at an all-time high. So first off, congrats if you own this company. You got to be up on your position. They're a Chinese company, so they're headquartered in Singapore. Let me see. Yeah, so they're headquartered in Singapore. We've converted the currency to US dollars so we can get a better idea of what they do. Oh, they're only at a 15 forward PE, and they are a bank. So a consumer bank / wealth management, institutional banking. And I'm assuming, yeah, so 65% of all the revenue comes from Singapore. Another 17% comes from Hong Kong. And then they got some Southeast and Southeast Asia revenue. So here's their net income, and this is in US dollars converted, by the way. This bank really does make 1.5 to 2.5 billion of net income every single quarter. So they probably, nice dividend. You get a 4.4% dividend yield. They're at an all-time high. That's actually crazy. Congrats to them for being at an all-time high. I know a lot of US banks are doing pretty good as well. JP Morgan is up a lot since 2019. They've like more than doubled. Any stock recommendations? So yeah, these are the stocks I really went over at the beginning of the stream that I think are really interesting to watch next week. Netflix. I'm really a fan of Netflix right now. Uber stock and Lowe's. Probably all names, if you're in America, you've heard of before. So I really like Netflix, Uber. So someone said DXYZ, and then we'll look at the bank's dividend is good. So yeah, cheese fries. What's up, man? How do you make your money to invest? Well, hey, actually, from my old YouTube channel. That's how I got most of the money I have to invest in the market. I have an old YouTube channel called Rust Moments. Used to make Rust videos. Maybe I'll pull it up if someone wants to see it. But anyway, this is basically a private equity ETF with a super high expense ratio fee that makes it, in my opinion, not buyable, sadly. But here's what this company owns. It's a way to get exposure to Anthropic, SpaceX, OpenAI, Mr. Beast, or Beast Industries, which is Mr. Beast company and his Feastables and his channels and all that. So it gives you exposure to all these private companies because none of these are publicly traded. It specifically owns private equity stocks. But the annual management fee is at 2.5%. So 2.5% of your entire position is taken away as a fee every year. So that's the one bad part. But there's just been a lot of positive momentum around certain companies like SpaceX IPO and stuff like that. I got $5 into Futu. It's good. Should I add more? Yeah, dude. Congrats, man. Your future self will thank you for investing. You don't even have to deposit like $5 a week. Your future self will thank you because the goal isn't to get rich quick. It's just to compound annual grow your stocks. You're like 10% a year. That's what the SPY does. So you put $100 in, turns into $110 the next year. But as you reinvest a dividend, invest a little more, it goes from 110 to 150. Then the next year from 150 to 189. Or it spirals up, compounds up. All right, next up we got what companies do you see having higher multiple expansion that you like? Yeah, that I don't know. McDonald's I like. Dave. Let's check out MELI. So this is actually international Amazon. So they specifically South American Amazon. So they do exactly what Amazon does, but in South America. So if we go to where the revenue comes from, 52% of it comes from Brazil, Mexico's 22, Argentina's 20%. So one thing that super impresses me is revenue growth here. Like actually hats off to this company for how impressive this revenue growth is. If it would load here, sorry. Guess my Wi-Fi is having a little troubles today. But check this out. Literally by the quarter, I mean, the revenue's at a new record. It's phenomenal. And this is in US dollars. They made 8.85 billion in revenue, up 50. So the revenue grew 50, but the net income declined by 14%. So what does that mean when the revenue grows and the net income declines? That means margins are going down. So I suspect why this stock has had such a gap down on earnings and have just been downtrending ever since is because they're losing their margin. Look at this. The same time last year, they had an 8.3% net margin. Now it's only a 4.7% net margin. It fell 43% year over year. So as over the past couple years, the margins have declined. So luckily, they're still a money printer. They're still making 500 million of after-tax net income a quarter. But it's just not keeping up with the growth rate of the revenue, which makes margins go down. If anyone's heard of Michael Burry, the guy from The Big Short, 2008, this is actually his only positioner now. Michael Burry only owns MELI. And the other bad part is, even on this massive dip right now, even on the dip, like 50% dip from its peak, today's price from a PE ratio isn't exactly cheap. On the right, they traded a 41 forward PE or 41 times next year's net income. I do think that's still too expensive to really trust. So here's DRAM. Yeah, hey, what's up, Chuck? This is a cool ETF right here. If you don't know which memory shortage play to buy, like if you've heard of this memory shortage with RAM, SSD, memory, all that, if you're like, hey, I know there's SanDisk, I know there's Micron, I know there's Samsung and SK. Which one do I buy? Well, this ETF just breaks your money up for you into all of the memory stocks. So if you don't know which one specific one to buy, you just buy this ETF. And sometimes it's more disciplined to just buy the whole sector instead of just one name. Same with the SMH semiconductor ETF. If you've heard of data centers and chips and stuff, you don't know which AI stock to buy. Should I buy NVIDIA, AMD? Well, you could buy this ETF. It breaks your money up for you into NVIDIA, Taiwan, AMD, Intel, Micron, Broadcom, Qualcomm, a lot of comms. But anyway, yeah, it's a more disciplined approach to instead of just buying one individual name. So yeah, smart there. So, Kev said SPMO. This is the S&P 500 Momentum ETF. So there's the S&P 500, and this one has actually done better than the S&P 500 because it's more semiconductor specific. Like if you go to its top holding, it's actually Micron. 10% of this whole ETF is Micron. Then it's then NVIDIA, then Broadcom, and then Google, AMD. So notice there's no Apple, there's no Microsoft, there's no Meta. It's like a bit of a more nichier ETF. So this could be a cool S&P 500 ETF alternative, but I would be afraid that Micron is pushing up. I kind of would like them to lower the Micron exposure. I was going to buy 20 shares of ARM as my first traded IPO, but it doesn't let me. Dang, Plasma. ARM has done really good. Thank you for BLLN. Too late to buy Snowflake. Oh yeah, BLLN is pretty cool. What's up, 1961? Is it too late to buy Snowflake? For the most part, yes, actually. I hate saying this, but for the most part, it actually is kind of too late to buy Snowflake, especially after this rally. I'll share with you why. They did have some good earnings and they had a good acquisition. Snowflake signs agreement to acquire enterprise AI agent platform Natoma. Is there a specific... Let me get my water here. Sorry, geez. Okay, so they rose their full year guidance right here. $6 billion 5-year agreement with AWS, bringing total customers with over 1 million in 12-month product revenue to 779. So they have 779 customers paying over a million a year. Oh yeah, look at the second line. Customer base expanded by 616 new net accounts, a 38% increase, with 779 customers generating over 1 million in product revenue. Dang. Wow. So anyway, that's the good news, but let me show you the bad news. They are still really far from profitability. And I just don't like trusting a lot of money in money losing companies. And as we can see, they're still far from profitability. They still lose roughly 300 million of net income a quarter. But here's why it's also okay for now, because they have phenomenal top line revenue growth. Like there aren't many companies that grow like this where the revenue by the quarter hits a new record. So phenomenal top line growth, but it's just a net income issue. They are just so far away from profitability. So yeah, they still have like negative margins, negative net income. And look at the forecast. They're supposed to lose 270 mil next quarter. Then it does narrow to only losing 245 million. So that's good. But yeah, so the way I normally value a stock is like with the forward PE, but there is no forward PE. So you basically, if you buy the stock, you're probably going to have to wait a few years for the stock to make any sort of net income. And when they finally make net income, then they can do dividends and share buybacks, but they have no money right now to do that. Hopefully that was kind of helpful there. That's why we really wouldn't buy them after the huge rally. So Bragg said, Elf stock, let's do it. What's up, man? This is a beauty and cosmetics company. You know, they sell like lip gloss, lipstick, I don't know, all sorts of makeup for women and stuff. So this stock has been on a downtrend recently. They did an acquisition, and I think it still underperformed results, or I don't remember. Oh, they lost net income this quarter. That's what it was. Okay, so yeah, analysts expected them to make 6 million this quarter when they lost 49 mil. And that wasn't some one-time adjustment either. If we go to the EBIT, analysts expected them to make 33 million. They actually lost 31 million. So that's the one sort of bad news, because before today, they're always making net income every quarter, but then they just surprise lost a bunch of money. So that's the one bad news. But revenue growth is really good. That's the one thing I am impressed about Elf Beauty with. Revenue growth is like straight up. I mean, revenue's up 35%. Part of that is from this acquisition they did back here. They bought a company for 600 million. That's why that same quarter, the balance sheet changed huge out of nowhere. But yeah, I think this is now, I'm assuming this is like a one-time adjustment, but like they're at a 22 forward PE. So as long as analysts are right about the future net income, they're going to be just fine. 22 forward PE, or only 22 times next year's net income. If they can just, make 45 mil next quarter, 20 mil the quarter after, that'd be great. So is there any other news around Elf Beauty? Elf Beauty reports 2026 earnings with net profit down 77% despite 25% revenue growth. So yeah, that's a margin thing. Okay, so unusual items totaled 66 million, so we're in reduced profit. So there you go. That was the one-time adjustment. So the net income would have been positive, like a couple million, but looks like that was the thing that got it. What is LQDA? LQDA. I've never heard of this one. Liquida. Hey, what's up, Carlos? What's up? So LQDA, let's see what this is. Liquidia. And then we'll look at NVO. Yeah, hey. Oh, excuse me. Actually. Okay. So I muted my mic for that. No one needed to hear that. So here's the stock right now. I'm a little congested right now. The stock is at an all-time high. So congrats if you own this stock. You're definitely up on your money. So congratulations. Let's see what they do. So product sales, net income forecast are so good. I don't believe it. They lost 3 million Q3 of 2025, but Q3 of 2026, they're going to make 100 million. Let's see the net income right now. So as we can see, they just had their most profitable quarter ever in their history. They made 51 or 52 million in net income. It's not done. It's supposed to hit 82 million net income next quarter and then 100 million the quarter after. Holy schmoly. So a forward PE is only a 12. They only trade at 12 times net income. So even though this stock is at an all-time high, I'm going to put this one on my watch list. Thank you. This one, in my opinion, is just going to continue to climb higher. What we normally see is, fun fact, whenever a stock hits a new 52-week high or all-time high, it's statistically followed by a cluster of new all-time highs and 52-week highs. The same is also true in the other direction, like when a stock hits an all-time low or 52-week low, statistically followed by a bunch more 52-week lows. Anyway, though, I can't believe this EBIT net income forecast growth. So let's see what they do. Are they like a manufacturer of prescriptions? So they manufacture prescriptions in North Carolina. Um, Elevated standards about us. So, oh my goodness. They're saying I'm AFK. Hold up. Okay. Sorry, the stream's back now. They made me fill out a CAPTCHA thinking I'm AFK, but expert in pulmonary hypertension, developing prescriptions to address unmet needs of pulmonary hypertension. Anyway, some sort of manufacturer, something to look more into for sure. I actually, even at all-time highs, they're still worth looking into. Thanks for that one. Those are the kind of stocks I really like. So someone said Novo Nordisk. Let's do that one, EXP. And then Tangrica. Yeah, we'll look at Rocket Lab and Costco for sure. So Novo Nordisk right here, this is your weight loss company. So if you've heard of Ozempic, Elon Musk is on Ozempic. If you've heard of Wegovy, these are weight loss prescriptions. But there's definitely some reasons why this stock is way off an all-time high. The stock was $120 a year ago. Now it's $30 or $45. So basically the main reason is they lost their exclusivity and they lost their patents in earlier this year. A couple months ago, and I believe in March, they lost their Ozempic patent in India, in China, in Europe, and some other countries as well. So their main secret sauce, the patent for their semaglutide prescription or weight loss prescription is now, it still goes through 2029 in the US and 2031 in another country. But anyway, let's see. So yeah, basically, if we look at this company's revenue breakdown, obesity and diabetes care is 95% of their entire revenue. So this, is mainly a weight loss prescription play, and they still make good money. Wow, they made $9.2 billion before tax and $7.5 billion after tax. That's super impressive. Like, I can't believe that actually. Let me see. Wow, okay. Wegovy pill launch in US achieved over 200,000 weekly prescriptions and 2 million total prescriptions. Wow. So yeah, Wegovy pills are working really good. Morningstar says they're undervalued, stronger than anticipated sales of Wegovy pill, highly promising R&D pipeline expansion into obesity adjacent markets, and massive global demand for GLP-1 therapies will drive long-term value growth despite near-term US pricing pressures. Oh yeah, so basically they got added into Medicare and Medicaid. They're Ozempic, and basically they had to agree to cut the price from like $199 a month to only $49.99 a month for these weight loss or for the Medicare members, and so that put a short-term strain on profits because obviously they're charging a lot less for their products, so sales and net income go down. Anyway, if they can keep up what they just reported, I'd be really impressed. Is there any news? Novo Nordisk to present data at 2026. Brazil approves first generic version of Novo Nordisk Ozempic. So yeah, look at that. Looks like in Brazil maybe there's knockoff Ozempics because there's no patent there anymore. So the worst might be priced in. That might be the thing. The worst might be priced in. So Tangrica said Costco. This is a very safe business to buy. Unfortunately, they're pricey, but they're pricey for a reason. Even in a recession, people still got to buy groceries and toiletries and stuff like that. And Costco is kind of one of the best places to go because when you go there, you buy stuff in bulk. And when you buy stuff in bulk, you get a better deal on it. And you also have to pay for a subscription just to get into the store. So whether or not you go to the store, Costco still gets that, monthly or quarterly subscription revenue. Retail sales grew 12%. Digital sales surged 22%, highlighting successful e-commerce investments, while membership fee income increased 10%. So look at that. That reoccurring high margin subscription fee. So let's see what the multiple is. This is the bad part. They traded a 44 forward PE, which means they traded 44 times next year's net income. It's too expensive to buy. But is it like this way for everyone else? Going into a Costco is a vibe. You know what I'm talking about? Like, I love the food core. Like they got the $1.50 hot dog, and it's always just like they have lost leaders, like the $5 rotisserie chicken. They have these lost leaders that drive sales up more. That long term actually make money on it, even though they lose money short term on it. But anyway, yeah, here's their bottom line right here. They're still making over $2 billion of after tax net income every quarter, and look at the trend of that over time. It just consistently goes up. They're opening up new stores every month, so I'm a big fan of Costco. I think the reason the stock is just declining right now is because their main competition, Sam's Club, Walmart, is also struggling right now. The past week they're on a massive downtrend, and so Costco is just following that. I would own Costco if they weren't so expensive. I love the business model. I'm developing pulmonary hypertension on this market right now. What's up, Jerry? Can you do Macy's? Mike Murphy, what's up, man? What's super weird about Macy's is so Berkshire Hathaway. Everyone knows Berkshire Hathaway. It's the company that Warren Buffett runs. Well, he no longer runs it. This is the first ever quarter where Warren Buffett no longer makes the decisions. And someone from Berkshire Hathaway just bought for the first time ever. Their newest positions was Macy's and Delta Airlines. Like, those are two stocks Buffett would never buy. But let's analyze Macy's. Like, this is retail, mall retail. Simple. This stock, Macy's, if you bought them in the year 1997, their IPO at 20 bucks, you've made $1 per share. So in 1998, it was a $20 stock. 2026, it's a $21 stock. So the stock has been flat for like 3 decades. They have a dividend, a 3.35% dividend yield. But if you buy this stock today, do I really expect you to outperform the S&P 500 in the long run? No. When you kind of just think about a Macy's, they're very recession prone, like they got crushed in COVID. And here's the revenue growth. Organic revenue sales, the lifeblood of the company. Revenue's down 1% year over year. Last quarter grew 0.2, which doesn't beat inflation. Negative 1.9, negative 4, negative 4. So look at I can see why this stock has done so bad. There's nothing really blowing me away here. Sales are lower than they were in 2019. They still actually, good news, they still actually make profits though. Like for the past 4 quarters, if you average it out, they actually make like 100, 200 mil a quarter, but not one I'd really trust long term. I have a debt problem too. So, I've looked at PLPC. I actually almost bought this stock one time. And then I want to look at GSL. We'll look at that one. That's your shipping company. So here's Performed Line Products. Dang, and now I'm wishing I did buy this one. They're even at all-time highs. They're not super big. They're only worth $1.8 billion. And what's up, Eric? Yeah, we'll look at Alibaba. What's up, Chuck? Novo Nordisk is a monster. Love owning that one, but wouldn't buy more. Yeah, hey, AJ, yeah. Yeah, I definitely wouldn't fully sell out of Novo Nordisk. Okay, so here's PPLC. They're at a 30. Look at how that falls. They currently trade at 54 times net income. They only trade at 35 times next year's net income. So they're having a good bit of net income growth. And there's now net income forecast. Yeah, they're supposed to make 14 million of net income in 2 quarters. If we zoom out, has it ever been that before? I guess maybe back here in 2022, but 14 million is the highest in like a couple years of net income. Revenue's up 18%. Looks like they're in the energy industry, which is up 22%. Communications is up 13%. Specialty was down 1%. Oh, it's a nice dividend pair too. You get a 0.2% dividend yield, 11% payout ratio. So this could be like an AI beneficiary. PLP, where does their revenue come from? So look at that. USA is half of the revenue, European, Middle East. Well, anyway, PPLC is interesting. I don't know if I'd buy them at all-time highs, but seems like some sort of cool AI infrastructure play. So GSL, this is a shipping company. They own a fleet of cargo ships that ship a bunch of cargo. So yeah, they did just gap down on earnings. Let's see if we can figure out what caused that. So they beat on revenue. They beat on net income, they beat on EPS, and they beat on EBIT. So they beat on every single metric. But someone in the chat said it's something that they said on their earnings call. So maybe there was some bad tariff guidance or Strait of Hormuz guidance that hurts future earnings. I have no clue. So yeah, here are their actual ships right here. Basically just cargo ships that they get paid money for the people that store their cargo on the ships. So this is mainly, people love this stock because of the dividend, and they really do have a safe dividend. So if you look at this right here, they have a 6.3% dividend. At first glance, that sounds crazy. Is that really sustainable, a 6.3% yield? Here's why it actually is. So here's the net income the past 5 quarters. If we zoom out, we can say on average, they're making at least 90 million in net income a quarter. Or we'll just say 90 million. So they're making no matter what 90 million in net income a quarter. If we go to how much the dividend cost exactly every quarter, it only costs 24 million. So they definitely can afford the dividend, and they even have room to raise it. So that's what I like doing. I like digging into the actual numbers in the cash flow statement to see how much exactly the dividend cost, and we can see that the 6.5% dividend is safe. So cool, GSL. I know that one still, it's very cyclical. Like if we zoom out, technically the stock is the same price that it was in 2014, but they've had a great past couple years with the supply chain issues. All right. Hey, Tangrika, with that crazy heart gift there. Thank you very much for that. Which one should we look at? Said FGMC. And hey, what's up, Kendrick? Thanks for the kind words there. And DCY. Nice AI speech. I don't know what I was talking about there, but this definitely not AI. Do I sound like AI maybe? Okay, FGMC. So this is Merger Corp. So this is a blank check company that basically just acquires assets. If I had to guess, so yeah, blank check company, a shell company. They have 2 employees. So basically, what they do is they own stocks or they just own stakes in companies. And I have no clue what this blank check company has a stake in. Boxable public listing. No way. So they own Boxable. That's gotta be, Elon Musk. It's basically one of those like mini houses. Um, if you like Boxable, you love Cavco stock, CVCO. That's the one I own. They do mini factory built homes too. I think it's way better than a Boxable will ever be. But yeah. Hopefully that was kind of helpful there. That's Boxable if anyone's ever heard of that company. So someone said SanDisk, or that was Looney Zone. What's up, man? Shout out to member Looney from the YouTube stream. GSL talked about uncertainty with the security of some of the ports. Oh yeah, no sane captain right now with some of these seeking mines and stuff like and drone strikes. No like sane captain will you actually shear a ship through some of these dangerous waters. So and it's causing the supply chain oil shocks. So here's SanDisk right here. Here's another supply chain huge issue of memory, RAM, SSD, hard drives, memory, all that. There's a huge shortage, and this is one of the best plays to buy this memory shortage. So they're at an all-time high right now. From a technical point of view, the sucker is overbought. Most people think there's no upside left, but here's the crazy part. This is why I don't think we're in like a peak bubble yet. This isn't the peak, I don't think. I think could be another 20% upside, but that might be it. But look at this. The forward PE is a 10. What does that mean? That means they only trade at 10 times next year's net income. I don't think that's the peak bubble. You know what I mean? Only 10 forward PE, maybe like a 14, 15 before it fully maxes out. But yeah, look at these net income projections. On the very left, they only made 112 million net income. On the very right, they're supposed to make 5.9 billion in 2 quarters. It has never even been close to 5.9 billion in net income before. So this stock is pricing in all the future growth that they're going to have next year. And when we value them off next year's net income, it's only a 10. And that's why I feel like that one still isn't maxed out yet. Same with Micron. Micron's at like a 12 forward PE. So they're not too terrible. Billy said Clara. That's a buy now, pay later stock, I believe, kind of like an Affirm. So here's Klarna Group. Let's see what they do. They actually made $1 million in net income this quarter. So this is their first, again, they just IPO'd like 2 quarters ago. So this is the only data we get. I can't zoom out. And this is the first ever quarter where the net income is positive. So great news. They did make net income. Oh, what happens is, yeah, hey, again, if you'd like to get this app I'm on, it's actually linked in my bio there, linked in my profile bio there. I'm on an app right now called Moomoo. This is my favorite app of all time to buy and sell stocks on. Costs nothing, completely free. And if you sign up with my link in my bio, we'll both get like $100, or we'll both get a free stock if you deposit $100. So yeah, linked in bio, or you can type it into Google, brokerage called Moomoo. But anyway, here's Klarna right here. This stock, let's see, financial tech company, credit services. They're actually headquartered in London. I thought they were a US company. They're actually headquartered in London. Oh, they have an investor presentation. Well, here's their investor presentation. Active customers, merchants that grew 21 and 59% year over year. So yeah, that's why like sometimes going into the investor presentation, they break down the news. So they're going to make around like 30 mil in net income next quarter. So that's great. So they gave good guidance. So they're going to be net income positive next quarter. So net income, here's the analyst forecast. They're supposed to lose 25 mil next quarter, but then make 19 million. Well, anyway, Klarna's revenue grew 44% year over year. That's the highest growth rate on the whole screen. So yeah, great news on Klarna, but I still would be careful because there is no forward PE or a 66 forward PE. That's not exactly cheap. Actually, I don't know if they're a buy now, pay later stock, just some sort of merchant solution company. So never too late to buy Apple stock. Yeah, Apple's a beast. You just want to never sell that one. I used to not like SPY for some reason. I was always chasing high profit, but The consistency beats everything else in the long run. Exactly. The average hedge fund, retail investor can't beat the S&P 500's return. So if you can't beat it, at least own it as a small position. No financial advisor will call you crazy for saying, "Hey, I'm buying some S&P 500. Does that sound okay?" Yes. And again, none of this is financial advice. I'm not an expert. Don't listen to me. I sell nothing. I have no course, book, WhatsApp. I sell nothing, just under give my opinion. And if you'd like to support me, please leave a like and follow. I try and stream every day. I stream every Sunday at this exact same time. But all right. I see Raytheon. Let's do Raytheon and Apple stock too. And again, I do apologize if I'm missing out on some stocks here. And then we'll check out Microsoft. So here's Raytheon. This is, instead of owning the war, this is the company that sells the bullets and the missiles. This is the picks and shovels aerospace and defense play. They're the ones selling the super expensive missiles and ammunition to the government and the military. So it's a great dividend growth stock. You buy the stock today, you get a 1.5% dividend yield. So they own Pratt Whitney, they own Collins Aerospace, they own Raytheon, which sells the bullets, and they print net income every quarter. And especially if war starts to escalate again, war fears, this stock should just continue to climb higher. But yeah, check out this bottom line. Easily 1.7 to 2 billion of net income every single quarter. And look at the net income forecast. It's going to go from 1.5 to 1.98. So there is still good EPS growth. Expensive though, at a 31 forward PE, that's the tough part. A lot of aerospace and defense stocks are expensive right now, like a GE Aerospace. So let me get to Apple. Then remind me to get to Figure, FIGR. Oh, and Fortinet. Okay, yeah, FD&T. Yeah, hey, is that the ticker? EXP. Give me the ticker symbol. What time is your live on Sundays? At 12 p.m. Eastern time. So for me in the very top left, it's 1:22. So basically an hour and 30 minutes before right now exactly. So every Sunday, this exact same time. And if also, actually, the best way to support me is go subscribe to my YouTube. I'm really trying to build on my YouTube. Actually, I just got a notification from TikTok. Your live is no longer eligible for recommendations and is restricted in results because it contains unoriginal or reproduced content. So there you go. See, TikTok just took down my stream. So the viewers are going to get cooked from here. I'm actually going to have to end the TikTok stream in a minute here. So if you would like to support me, the only way, I sell nothing, the best way to is just please watch from YouTube. Watch the stream from YouTube. My YouTube channel is called Nathan Robert. It's in the link tree, or it's in my, you type into YouTube Nathan Robert, you'll find it. Anyway, here's Apple stock. This is a phenomenal buy and never sell company. Unfortunately, it is at an all-time high, but they deserve to be at an all-time high. Someone said, I'll follow you on YouTube. Yo, I'm actually going to give you a follow on TikTok. Thank you very much for following my YouTube. Thank you so much. I'm always having issues with TikTok. So anyway, Apple right here. This, here's what they do. They sell you the iPhone. They sell you the iPhone for a low margin, but then the way Apple makes most of its money is through App Store commissions. Every time you buy, Clash of Clans gems or something, or Candy Crush gems or something, Apple literally keeps 30% of that entire transaction as a developer royalty, a developer fee. So they keep 30% of every transaction that happens in the App Store. And that business does over 109 billion of annual revenue. And and that's all very high margin. It actually breaks down the different margins versus their hardware versus their actual services. Oops. I just clicked off Apple. So yeah, the services have a 75% margin. Isn't that ridiculous? Versus the iPhones have like a 25% net margin. So yeah, here's their after-tax net income down here. Apple is it's a money printer, literally cash flow generator. They're making 30 to 40 billion of net income every quarter. And then what does Apple do with 30 to 40 billion a quarter? Well, they pay a dividend, and that dividend only costs 3.82 million. So they have a lot of room to raise their dividend. So there's a nice dividend growth company. And they also do massive share buybacks. They on average spend 20 billion of their we can scroll back to 2020 or 2020 even. They always buy back like 20 billion of their own shares every quarter. That's the way Apple really returns money to you as a shareholder, and it's the reason the stock never goes down. They buy back 3% to 5% of all the shares that exist every year. So the stock just in the past 5 years, they bought back like 15% of the entire company. So that's what supports the stock price. Plus, the net income continues to grow. A lot of people are locked in the Apple ecosystem. A lot of people have the iPhone and the AirPods and the Apple TV and all that. So Apple's a great company. I wish I owned them. You get a nice dividend, low payout ratio. And they're actually being rewarded for not spending so much on AI. We just saw Apple hit an all-time high on Friday. Meta is still a good chunk off all-time highs. Why? It's because they're questioning their spend, because Meta's not winning on the LLMs, when Apple's not even attempting to spend and build out data centers and LLMs. They're just paying Google Gemini. Hey, cheese fries. Thanks, man. Yeah. You can't say YouTube. Yeah. Well, the stream's already cooked, so hey, I guess I could say anything at this point. So let's do Cheese Fry says Nokia, then we'll do Fortinet and some of these other companies as well. So actually, Nokia is one that Nvidia just bought. So Nvidia is so big, they of course own Intel, CoreWeave, Coherent. Then 6.5% of their portfolios in Nokia. Quite interesting. And when we think of Nokia, we think of that smartphone company. You know, they lost to Apple. You know, in 2007, we just looked at Apple. They are not a smartphone company anymore. So it used to be a $40 stock. Now it's a $14 stock. But look at the momentum they've had this past year. A lot of this momentum is from an Nvidia investment, but it's also because they've really kinked out their numbers. They make good profits every quarter. Next quarter, they're supposed to make 260 million of net income. Next quarter after that, 390 million net income. So they're consistently going to be making from now on a couple hundred million of net income every quarter. So they really do have a forward PE of a 44. Look at how it gets cut in half. The trailing 12 months is an 85. It gets cut all the way down to a 44. So if I watch you on YouTube, you don't see my comment. I will see your comment. Sometimes I just sorry if I don't see it. Yo, you should test that out. I make sure to read all the YouTube chats specifically. I actually have a higher likelihood of analyzing your stock if you say it on YouTube versus TikTok. So yeah, the EPS is literally doubling. That's why the PE ratio gets cut in half. That's why you really want to do like a multiple year out multiple. And the other reason they've had so much positive momentum is because this is an AI and cloud play. Look at line number 2 right here. It says AI and cloud related businesses sales grew 49%, generating 1 billion euros of new orders, significantly boosting profitability. So this AI and cloud business, that's what Nokia is now. They're no longer this like smartphone company that makes unbreakable phones. You know what I'm talking about? So CBP, yeah, Campbell Soup. So they own a few different brands. You know, obviously, you know, all the Campbell Soup brands. They own Goldfish. And a lot of these consumer package stocks have been on a massive downtrend. It's not just a Campbell Soup problem. Look at like a General Mills, which owns, you know, all the cereals. The stock almost looks identical, this downtrend. So there's General Mills. And here's Campbell Soup stock. They're getting very cheap in terms of a multiple. They trade at a 9.9 forward PE. What does that mean? They trade at 9.9 times net income. Legit, like such a low multiple. 10 times net income, they could buy back a lot of shares a year. So yeah, here's what they own. Prego, which means you're welcome in Spanish or something. Pretty Oh, is they own? Oh, I love Kettle chips. Yo, these are like I love Kettle chips. I like how they're extra crunchy. Looks like I don't like these. I tried these recently. They're not even that good. Anyway, they got Goldfish. Okay. Anyway, V8 Juice. Those are their main brands. Campbell Soup. Next up. Yeah, hey. He's using Moomoo. Yeah, hey, Kendrick, if you'd like to get this app, yeah, I have it linked in my description there on YouTube. IBM is much better than Apple in terms of valuation, or because I probably would say Apple is valuation irrelevant. I'd rather own Apple than IBM in the long run. So let's see what's next here. Yeah, man, the Kettle chips are good, Damien. Good hedge it could be. You know, how much cheaper can these consumer package stocks fall? I don't know. And it's not just those as well. The whole food industry is struggling. If we look at Wendy's right here, this is kind of sad. You know, Wendy's is lower than they IPO'd in 1997. So Wendy's is the same price as they were in 2008. And it's not just Wendy's, you know, it's Red Robin, it's Jack in the Box, it's Krispy Kreme, it's all these companies. They're all public. They're at the same price as they were legit back in like 1998. Yeah, here's Jack in the Box. Same stock prices they were in 1999. RIP. All right, VOO. Someone said, yeah, that's just the S&P 500. You can't go wrong owning this. This should be like it's a great backbone. It should be like the backbone of your portfolio. It owns great. I'd happily own all these shares right here. It breaks your money up for you. Buy market cap weighted stocks. So let's do next up. Oh, FTNT. Then we'll do Broadcom. Oh, I love Fortinet right here. So this is a cybersecurity company. This is the part of software that I'm extremely bullish on. Out of all the software sectors that could get hurt by AI, like maybe a Duolingo is really exposed to AI. Fortinet is not, in my opinion, this one should not have been beaten down so much when software was dipping. I'm a huge fan of cybersecurity, and this is a subscription model cybersecurity company. 38% of the revenues, their security subscription. And check that out. This is really growthy. I mean, every year it just hits a new record. And that's what you want to see, reoccurring subscription revenue. It's very predictable. And here's their bottom line. A lot of companies like software aren't net income positive yet. But check out Fortinet, FTNT stock. They are the most profitable they've ever been. They're making easily like 400 to 500 million of after-tax net income a quarter. And actually, that was a good beat. Look at this beat on net income. At the bottom, the orange line, analysts expected 387. They did 534, and this wasn't like a one-time gap adjustment. This was real EBIT beat. Analysts expected 542 earnings before interest taxes. They did 662. And they beat on revenue. So they're not just at all-time high for momentum. They genuinely they had a great earnings beat that quarter. Oh yeah, I forgot to get the Microsoft. My fault there. So yeah, Microsoft, this is the number one software company. That's why the stock, was on such a downtrend. It went from 550 to 350. Because this is the number one software company. Think Excel, spreadsheet, PowerPoint, Word. That software business from Microsoft does 120 billion of annual revenue for them. Hey, Tinkriga, we'll look at BLK after this. I got you. So yeah, this one their software does 120 billion revenue a year. Then their intelligent cloud, their Azure cloud also does over 100 billion of annual revenue for them. So this is a great software company. It's a great cloud company. It's a gaming company. They own Activision Blizzard. They own Minecraft, they own Xbox, so many gaming stuff like that. So Microsoft, if we go to their net income forecast, they're supposed to make over 30 billion in net income from now on. The net income growth is just phenomenal. They have a better credit rating than the US government. Net income just like hits a new record every quarter. It's just one of the safest companies. Like every company in one way or another uses Microsoft. Microsoft was a good buy during the software sell-off. That's actually the one I bought during the software sell-off. So here are all my most recent purchases in their exact order. There we go. On that same day, the same day I bought Microsoft, I also bought AppLovin and I bought Uber. Uber's only up 3%, but yeah, Microsoft, I literally bought this one weeks ago or like a month ago. On this day right there, there's my little buy order. I bought all 3 shares that day, and it's specifically on Friday, they were up 5.5%. I was shocked. So that's a big move for the mega cap Microsoft. It's a phenomenal buy and never sell company. So yeah, Fortnite stocks, yeah. Okay. That's why I don't like to use TikTok. Yeah, hey, what's up, Emperor Penguin? I appreciate you. So BLK, this is BlackRock right here. They own so many ETFs. So if you've heard of like the iShares gold ETF or the iShares Bitcoin ETF, BlackRock is the one that owns iShares, and this is a PC private equity company. They're cheap at an 18.7 forward PE. That's why I actually think this one is still undervalued. This isn't like where they're going to max out in valuation, I don't think. So yeah, private equity is 35%. Then they have this alternatives revenue. This is their Bitcoin and Ethereum ETF business specifically. I'm really bullish on this growth. Full year 2024 to full year 2025, revenue grew 71% that year. Again, mainly led by the introduction of the IBIT ETF, so their alternative business is growing. Oh yeah, they also have this technology subscription business. If we go to the annual trend here, another one that's just at a record right now. How about their fixed income? Annual basis. Okay, that one's kind of flat from a while ago. Equity, that's at a record as well. So if we just go to net income down here, they easily make every quarter like 1.5 to 2 billion net income, or I should look at operating profit. This is really what the profits actually are. Yeah, easily making basically 2 billion. This is before taxes. So they basically make 2 billion of net income every single quarter. Revenue grew 26%. That's an impressive growth rate, 26%. So yeah, here's what I mean by their ETF business. If we go to the IBIT ETF, the iShares Bitcoin Trust, BlackRock is the one that runs this ETF, and they charge you, if you own this, a 0.25% yearly fee. So whatever your position is, $1,000 or whatever, they take 0.25% of that every year. And that's how they make their money, from these high margin fees. Pretty cool. So next up, I see IBM pays a much bigger dividend. Oh yeah, they do have a good dividend. Heard Jeff Bezos shaved. What? Okay, well, FIS is a software that has a great dividend. Is that Fidelity? Okay, so yeah, Fidelity. I think this is like a brokerage as well. Fidelity might just kind of be being out innovated by like a Robinhood, a SoFi. I don't know. Let's check it out though. So they're at a 12 forward PE. That is one thing weird. So even at this all-time low level or like multi-year low level, the sad part is they're fairly valued because a 12 forward PE, that's what like a Morgan Stanley, a Goldman Sachs, a JP Morgan, that's around the forward PE they trade at. So the sad part is even on this massive dip, they're not super cheap, I don't think. But let's check this out. Revenue grew 30%, and here's the real profits they're making. So yeah, they're consistently making like 3 to 400 million of net income a quarter. You get a 3.81% dividend yield. The payout ratio had a little one-time adjustment, it looks like, because the net income is having a lot of weird adjustments. Like, here's the before tax number, they're making 500 mil. Then the net income this quarter says 2.37 billion. Well, that obviously isn't real. And then this quarter says they lost 470 million. Well, they didn't actually lose money that quarter. They actually made money. So, interesting there. Forward PE is a 12.5. That might actually be slightly undervalued. All right. Dividend's kind of bad for me. I will get 30% taxes because I don't live in the USA. Yeah, exactly. So here's how it works in the USA. Like if I got a $100 dividend from an ADR, they instantly take it out of your dividend at 30%. So I'd only get $70, but that $30 that I didn't receive, I actually get it as a tax write-off. You get to write it off from your profits or like an income tax write-off. So let's see. If you were starting as a new investor, what would be your first 3 purchase shares? Well, if I was a new investor, I'd want to keep like I'd want to be safe. I want to put like the backbone of your portfolio in like an index fund, like a S&P 500, a QQQ, Nasdaq 100. Because the average investor can't outperform it. But then after I own the S&P 500 or a nice diversified index, I'd pick some of my own companies. Buy what you love and use. If you like Coca-Cola or if you like Amazon or if you like Netflix. Netflix is one I'm a super big fan of. Actually, if you're looking for a stock to buy, Netflix, buy stuff you understand. It's an easy one to understand. Netflix subscription model company. What program is this? Hey, Chris, yeah, this is actually a brokerage. If you'd like to get this app I'm on, it's actually linked in my bio. It's an application called Moomoo. But if you use my affiliate link up there, we both get like a free stock if you end up depositing $100. So, must be rich to live in Singapore. Hey, what's up, John? Short the bond market. Oh yeah, if we look at like a TLT, basically there's now a chance of rate hikes. You know what? I'll just show you that. If you're wondering why is bond struggling, why are interest rate sensitive sectors like a Lowe's, real estate struggling right now? It's because of rate cut expectations. For this June meeting, there's a 99% chance of no cut and a 0.7 chance of a hike. Then the next rate, 95% chance of no cut, 5% chance of a hike. September meeting, 17% chance of a hike. And then, so that's kind of the bad news. They're actually now pricing in interest rates going up 1% potentially this next year instead of going down. So that's why there's a lot of struggle on Lowe's, Home Depot, TLT, bonds, all that. The US 20-year Treasury. Okay, let's see. Check what Trump is holding, or he actually, I don't know if they break that down anymore. I don't know. Because I heard he bought Palantir or something. I don't want to get into politics though. FIS has insider buying. Oh, nice. Let's see. We'll look at a few. I do got to go in 10 minutes though, which is unfortunate. So why McDonald's price down? Hey, well, that's an industry problem. Look at Wendy's, similar. Look at Wendy's the past year. They're lower than their COVID price. Wendy's is the same price that they were back in 1999. Jack in the Box, Chipotle, all these food stocks are on this massive downtrend. Even the food package stocks like a General Mills, look at that one on the dip. So McDonald's is no exception. They're also falling because a lot of food stocks are struggling with inflation and tariffs. And I think out of all the food stocks to buy on the dip, honestly, McDonald's is the best one. They have fallen the least. And also, I like their business model more. It's going to be safer in this rougher time because this is really a real estate and royalty company. They own the land under 80% of all the franchises, and they collect a royalty, a sales and marketing royalty of 4% of every transaction at every franchise. So if you can spend $100 at a franchise McDonald's, the parent company, the stock gets a $4 royalty from that. So that's why I own McDonald's. It's a bit more recession resilient than like a Wendy's, which is a corporate, or like a Starbucks that owns their own stores. I like McDonald's the most because they don't own the low margin part. They keep the high margin part. Wendy's tastes better though. Hey, unfortunately, Wendy's stock is beaten down hard. Honestly, if whether I go to Wendy's or McDonald's, I'm happy either way. I love things from both places. All right, next up here. The cool thing about food is, even in a recession, people still got to eat every day. And I actually just recently went to Wendy's. Wendy's was actually quite expensive, more expensive than McDonald's. McDonald's finally has the value back. McDonald's has the $5 meal deal where you get a literal McChicken, you get a small fry, 4 nuggets, and a small drink for $5. It's actually it is a good deal. Next up, we'll see. Will Amazon dip with the Florida explosion? Hey, I don't think so. There was like a missile launch. Oh, are you talking? Was that a SpaceX rocket? Okay, or I mean, not SpaceX, a Blue Origin rocket. Let's see right here. That's such a small portion of their business. I don't believe Amazon will fall at all because this Amazon, and I've been loading the boat on this stock. This is an ETF in one. They own Whole Foods, they own Ring Doorbell, they own Twitch. This is an ETF in one. They're number one cloud play. They own AWS. Oh, I used to have like an image of all the like family of brands that they own. It's like a ridiculous amount. But anyway, they're the number one Fortune 100 company in the world by revenue. There's no company that does more revenue than them. They do 700 plus billion of revenue a year, and not just record revenue, but record profits as well. So if you're going to own a stock, you want to make sure they're growing like a beast. And not just the revenue, but the actual profits as well. And Amazon checks those boxes. Revenue's up 16, profits are up by 29. They don't make too much net margin shipping you that same day overnight package. The real reason Amazon has had this margin expansion, look at net margin. Look back here. This was an impossible buy. Amazon had like no margin, low single digit margin. Then it was 2, 5, and it's just been up ever since to a 16% this quarter. It's mainly because of this cloud business. Their AWS cloud, it's their most valuable business actually. Did you know that? It does 130 billion of annual revenue and it grows insane. It has 30% margins and they have a backlog of $800 billion. Can you believe that they have an $800 billion backlog for AWS? So they're also making their own TPUs, their own chips. So there's so many I could talk about Amazon all day. It's like a drone play, an AI play, robotics play, space play, grocery store play. It's like a UPS, an Oracle, a Walmart, an Instacart, all in one. So yeah, and you can't out innovate Amazon. Basically what they say is if a company has a good margin, your margin is our gain. We'll do what you do, but for half the net margin. We'll still make a profit. We'll just do it for half the margin. And that's how Amazon gets their scale. They literally they invested 65 billion this quarter, 50 bill last quarter, 30 billion. There's no company that has a higher CapEx than Amazon. So that's why I'm so bullish. So Amazon, they're unlike every other Mag 7. They actually dilute you by 2 to 3% a year. They don't do dividends either. But the reason that's okay is because of how good or how much they spend. They just buy new companies. They invest in the future. That's going to be accretive to the EPS. They buy businesses that, anyway. I love everything Amazon's doing. What's this one? Insider trading has never been more rampant. Yeah. Yeah, and there's also a lot of fraud around prediction markets right now. Like certain people in the military, like doing like those missile strike prediction market bets right before they happen. Or if you're worried, then buy SCHD. Yeah, SCHD, this is a more dividend-focused ETF right here. If you want dividends, this one doesn't outperform the tech-heavy S&P, but you do get nice dividends. Here's what it owns. It's a lot of the higher-yielding names like a Qualcomm, United Health, a Coca-Cola, a Chevron, Verizon, Procter & Gamble, Pepsi, ConocoPhillips, so those kind of stocks. What's the sector breakdown? I think it does that for us. They have 95 billion assets under management. Try not to spam there, Jay. Oh my goodness. What's all these underscores and stuff? So sectors, oh yeah, so 20% is tech, consumer defense, healthcare, energy, financial services. Cool. So there's SCHD. Oh, and I forgot to show you the main part. It has like a 2.8% yield. So you buy this ETF right now, yeah, 3.25% dividend yield. Nice. Yeah, oh yeah. Hey, Michael said another food stock right here, PTLO. This is Portillo's. So again, if you were here a minute ago, we just looked at Wendy's. We looked at Jack in the Box, Krispy Kreme, Red Robin. They're all at like their 1997 prices. Well, here's another one that's food. Actually, this looks real good right now. Like chicken sandwiches, this kind of stuff right here. So maybe like a Checkers, I don't know. They're also struggling right now. Revenue grew 3.5, which is slow, kind of low single digit revenue growth. Last quarter only grew 0.6, but they're really having margin problems right now. So the revenue grew by 3 and it grew by 0.6 last quarter, but the profits fell by 36 and 23. So these restaurants are really struggling in terms of profits. Their margins are going down. So all right, that's PTLO, another food stock. Let's do Okta. So this is a software company. I use this one in my college applications. Like when I boot up my college software, it says like Okta in big letters in the bottom left. So I guess I use them in one way or another. Okta reports earnings beat with 11% revenue growth, raises their full year guidance. So that's great news. They bought back 240 million shares this quarter. So the company announced strong traction in AI agent identity products with partnerships including ServiceNow, Google, Amazon, OpenAI, and Anthropic. New product bookings accounted for 30%. Anyway, let's go look at their actual numbers. So they reported good guidance. Let's see what the analysts expected. So the orange lines, what the analysts expected. They expected 750. They did 765. So they beat on revenue. They also beat on net income. That's the best beat here. They expected 47. They did 74. And yeah, they beat on every single metric by a good chunk. So they really did beat on every metric. Revenue grew by 11, but the profits grew by 43. So that actually means their net margin is growing. Yeah, that's what you want to see. This company used to be a big money loser. You couldn't buy this stock 2 years ago. They were losing 100 million net income a quarter. Then they narrowed it. Now they're actually making close to 100 million net income every quarter, and they just gave some good guidance as well. So nice one for Okta. What's the forward multiple? Let's see if they have a forward, or they definitely have one. Oh, but it still does look expensive. A 79 or a 74 forward PE, or they trade at 74 times next year's net income. That is still a tough buy. You know what I mean? But nice. Maybe that's a strong sign that they're not going to get replaced by AI. Rivian Cough. Yo, actually, that's a big Amazon investment as well. I actually would not own this one. I mean, I own it via Amazon, but I would not buy this stock individually. Simple reason here. It's hard to trust these net income losses. So they sell electric vehicles, electric trucks, electric cars, and that is a low margin, or well, for them, it's a negative margin commodity. Tesla's margins are getting crushed right now too. So I'm not a big fan of Rivian. So I love their Amazon partnership. If we go down here, Amazon owns 12.3% of all the shares. Porsche owns 16% of all the shares. So they're backed by some good people. And I love has anyone seen those like electric Amazon delivery vehicles? They look so cool on the street. I'm an Amazon shareholder, so I'm happy. But here's why I wouldn't own this one individually. All they've done is lose 500 million to $1 billion of net income every single quarter. So that's the one part that's tough to trust. They just lose too much money. And look at the net income expectations. Next quarter, they're still supposed to lose 993 mil, 998 mil. So they're losing $1 billion a quarter or $4 billion a year. When you're worth 21 billion, that's a good chunk of your market cap. That's like almost that's 18% of the whole company a year they lose in net income. Hey, what's up, Jay Bosa? Dude, thanks for those gifts there. If you got a stock you want me to look at, definitely let me know there, brother. He said Okta. Oh, hey. Yeah, Okta channel breakout. I don't know about I'm not too good at technical analysis, but that's a nice gap up here. Congrats if you own that one. Yeah, I wouldn't really sell out of that one. Like, they really went up on good news. So GRRR, or TSM. Actually, let's do TSM. So if you didn't know, NVIDIA, they just design their own chips. They design it. Taiwan Semiconductor is the one that actually manufactures it. Taiwan Semiconductor's number one customer is NVIDIA. Their second largest customer is Apple. So Apple makes their own smartphone chips now, and Taiwan Semiconductor is the one that produces that. So this is your manufacturer. They're headquartered in Taiwan. Most of their manufacturing is in Taiwan, but they do have a fab in Phoenix, Arizona. But look at the forward PE. This is why, even though this stock is at an all-time high, or it's basically at an all-time high right now, it's undervalued in my opinion. This is why this is not peak bubble valuation. It can't be 25 forward PE or only 25 times next year's net income. That, in my opinion, could still stretch up to like a 29, 28 before it like maybe starts to look expensive, because it doesn't look expensive to me. Like, really, that's why I'm so bullish on Taiwan Semi. And look at this margin expansion and net income forecast. So in 2 quarters, they're supposed to hit 21 billion in net income. You see that on the very right? And also expect 21.4 billion net income. If we zoom out, it has legit never even been close to 21 billion before. So there is still a massive amount of net income slash EPS growth that this company is going to experience over the coming years. That's why I'm still bullish on Taiwan. You still get a good yield, a 0.8% dividend yield. Actually, that's a higher yield than Nvidia has. So 25 forward PE. It's hard to be bearish. You know, it's hard to be bearish on Taiwan Semi at only a 25 forward PE. I own PTLO. I only keep it to vote against management. I know it's stupid. These guys started up paying themselves as they were running a huge company. Dang, John. Yeah, as a shareholder, I would not be happy about that either. You know, the insiders milking profits when the business needs profits the most. Save the ones you save for later research. I would buy a Rivian truck, but not Rivian stock. Yeah, the Rivian trucks are dope. I actually see some of them in my neighborhood. Their main manufacturing plant actually is kind of close to where I live, so you wouldn't believe it. But I haven't seen a normal Amazon truck like in a long time. All I see are the electric Amazon vehicle trucks. All right. Hi Nathan, can you check UiPath? Thanks for the stream. Hey, we actually just looked at Path a minute ago. Basically, they achieved their first ever GAAP net income positivity. So they were 17% revenue growth, achieves first ever GAAP quarterly profits since their 2021 IPO, and they rose their guidance. So here's the bad news though. Even at like they're basically at an all-time low right now. Even at this all-time low level, I don't know if this is accurate, but I assume it is. They're at a 33 forward PE. That is still expensive. You know what I mean? A 33 times forward PE. Because here's the net income forecast. They're supposed to make 17 mil next quarter, 35 mil the quarter after. So they're not exactly a steal of a deal, even at this all-time low level. And I say that as someone who wants UiPath to do good, but I am a bag holder. Here, look on I'll just pull up the stock real quick. So here's UiPath today. If we zoom out way back to their IPO, you'll see my buy orders. They're about to load in. Look, there they are. I've been buying UiPath since over $50, even over $60 a share. Back in 2021. And I have been holding a bag ever since. So I can list every single sort of bad thing they did, from the CEO quitting out of nowhere and milking all the cash. Like I'm just still, it's not the high quality software name that you want to keep a lot of money in. You know, some actual high quality software would be like an Uber, Microsoft, AppLovin, Reddit, those kind of software names. UiPath is all right though. It's one you want to have as a super, super small position. Let's do Viva Systems before I go here. This is another subscription software company I actually do like this one. American Moomoo has all the Singapore stocks. Oh yeah, hey, yeah, Looney. I love Moomoo. So here's Viva Systems. If we go to their revenue breakdown, 85% of all their revenue is this subscription model business. And if we zoom out, it grows very nicely, double digits every quarter. It's up 16 after it grew 16, after it grew 13, after it grew 16. So really nice subscription revenue growth, but it's not just revenue, because if we can zoom out on the revenue, as we can see, literally by the quarter, revenue hits a new record every quarter. So record revenue this quarter specifically, and not just record revenue, but record after-tax net income. They made $244 million after tax. Before tax, yeah, so this is real. They really are making like $200 million in net income a quarter. So, and a huge cherry on top, a huge safety net is the fact that they have actually no debt. 6.5 billion of cash and literally no debt. What's the market cap? So they're a $28 billion company with $6 billion of cash, 27 forward PE, subscription model company, record net income. This is looking quality to me with a good balance sheet. So out of all of the software stocks to buy on the dip, that one, VEEV, could be one to put on the watch list. Another huge software dip is Intuit. This is your TurboTax. This is your QuickBooks, those kind of products. And they did give some bad numbers for their tax business, TurboTax business. So global business, representing 77% of revenue, led by 21% growth in QuickBooks Online accounting. So Credit Karma contributing $650 million in revenue, up 27% due to strong personal loan and credit card revenue. So that's cool. The one thing they did say that led the stock to fall, and it's no longer in the news anymore because it was when they first reported earnings, but basically they had 2 million less TurboTax filers than they did the same time last year. They were citing that these DIY tax filing, oh yeah, look, at the very bottom line here, DIY headwinds. These DIY tax consumers are weak. I'm wording that weird, so forgive me. But anyway, as you know, every single tax season, that's when they make the majority of their net income. So every Q3 is when they get the bulk of their net income. But look at the other 3 quarters. The other quarters in the year, it's now 3 to 600 million every quarter. When we zoom out, it used to be like they make all their money that one quarter, and then the other quarters are like super low. But now they've really evened it out. Look, so we saw TurboTax was struggling. We saw QuickBooks was up 22% year over year. We saw Credit Karma was up something percent. So yeah, 17 forward PE. This honestly might be close to the bottom. They also just cut a bunch of workforce. They cut like 17% of all their staff, investing in AI. So actually, I would put this one on the watch list as well. So Morningstar says they're undervalued. Robust switching costs in its dominant small business accounting ecosystem and strategic expansion into the mid-market will drive long-term value growth despite near-term headwinds from DIY tax filing segment. So yeah, that was the one bad part, the DIY tax filing segment. But yeah, Credit Karma up 27 and QuickBooks Online Accounting grew 21%. So not all is bad. So yeah, that was the last stock, the very last stock we'll do, and then I got to go. If you did enjoy, please leave a like for me. We've been streaming for over 2 hours and 15 minutes. I stream every Sunday at this exact same time. If you'd like to hit the follow button. If you'd like to support me, the only way to support me is subscribe to my YouTube channel. I promise I sell nothing. I have no course, book, WhatsApp. I don't coach. I'll never follow you, DM you. All I do is stream on TikTok and YouTube, and all I ask for is a like. I don't. It would mean more to me if you subscribe to my YouTube channel than leaving a donation, because TikTok, this stream is already taken off the For You page, and I hit appeal. They didn't accept my repeal. They said this is unoriginal and reproduced content apparently. So rip. Anyway, here's MasterCard. I really like this company. My YouTube channel. Oh yeah, I forgot to mention that. My YouTube channel is called Nathan Robert. Thank you very much. You can just type into YouTube Nathan Robert. I'm also streaming on there. The stream stays up permanently over there. So if you missed anything. Also, if you leave a comment on the stream, say, hey, at the very beginning of next stream, can you analyze this stock? I'll do that. I'll respond to all the comments if you say anything nice. So anyway, thanks again. So here's MasterCard. Last stock we'll look at here. You know, the small little micro credit card transaction fees that are slowly bankrupting us are making MasterCard a boatload of money. And Visa. And Tengrika, thanks for the nice words. And T-Boss, dude, thanks again. Oh, NEE merged with Dominion Energy. I saw that. They're now the largest utility in the world. Anyway, MasterCard has a 46% net margin. So if you go, spend $100 or whatever their business model is, whenever you swipe your card, they basically keep 46% of that dollar after tax, $46.23 after tax. So they're a money printer. So the revenue was $8.4 billion. On this $8.4 billion of revenue, they keep after tax $3.88 billion, which is a 46% net margin. It's incredible. And look at the FCF, which is free cash flow. It also has massive growth rates year over year. If they're making $4 billion plus of free cash flow a quarter, $4 billion of net income a quarter. What are they doing with $4 billion of net income and free cash flow every quarter? Well, first off, they pay a dividend. That dividend only costs $777 million. They actually just rose their dividend, so that's why the cost went up, because they just rose their dividend because the payout ratio is so little. They also do share buybacks. This is the number one way they return money to you as a shareholder. They just did their highest ever share buyback in history. They spent $4 billion of their basically cash on hand buying back $4 billion of their own stock because it's undervalued. Look at this multiple, a 24 forward PE for a company with 50% net margins. I love this company. And the dividend, you get a dividend of a 0.65 that they raise every single year. Oh, hey, I did look at BlackBerry, but you'll have to kind of find it in the stream. I actually analyzed BlackBerry twice on the stream, but yeah, you might have to scroll back and find it. But anyway, I hope everyone has a phenomenal rest of your Sunday. Thank you very much for showing up. See you soon. Stay safe out there in the market. Watch out this week. Oh yeah, and someone said, very last thing, the stocks I recommend this week, or I had recommended, is Netflix, Uber, Lowe's. At the very beginning of the YouTube stream, I deep dive into all three of those, super in depth, and I think you'll like the analysis. Again, I'm streaming on YouTube. It's called Nathan Robert. If you just type into YouTube Nathan Robert, you'll find it. And if you leave a comment or something saying you came from TikTok, I will do something nice. Thanks again. See you again. Thanks, John Bradford. Shout out to member Looney. Oh, if you private Discord I have, it's $1. If you'd like to join my private Discord, it costs $1. It's in the description. If you have any questions for me or need help with anything or want anything analyzed personally, your portfolio or a stock, it just costs $1. I made it $1 to keep bots out. I don't want any bots in that Discord ever. So I made it the very minimum, $1 to join. Or if you become a YouTube member, you also get permanent access to the Discord. Even if you become a YouTube member and cancel the next month, you are permanently in the Discord. $1 to join, link in the description. Have a great rest